Yeah. Okay. So how about this? Let's start our event on time. First of all, and I'd like to welcome each of you, and really glad to see you on this Sunday morning, October 24th. And thank you to join Connect Now, our online webinar. Yes. And so I also would like to, thanks for our partner and André Brouwers Capital. So Zikun, could you put our presentation on? Awesome. Yes. So first of all, I found it out today we still have some guests joining us, and I'm quite happy to really see a lot of the old friends, Connect Now partners and our members joining us. But also I'm quite happy to meet some new friends. And today we are really gathered online and around one topic: invest now, but how? Yeah. And so for this event, the main organizers are Connect Now investment partners, Brouwers Capital, and we also have some media partner to support this event. So now, and I'd like to use this chance to introduce, give some few words about myself and also about Connect Now. So my name is Gabby Zheng. In Chinese is Zheng Xue. And I come from a very beautiful city called Sichuan, Chengdu. If you have seen pandas, if you like hot pot, and you know what I'm talking about, yeah. And so Chengdu is actually only 9 hours away from Amsterdam Schiphol to my hometown, and I had been already living here already for 6 years. Yes. Do not ask my Dutch. My Dutch is not improving at all. But I actually had been I majored in the master degree in America. And Zikun, could you go to another slide? Thank you. Yes. So I majored in the business administration, and for more than 14 years of the working experience is mainly in marketing, project management, and in sales. I had been working for Baidu and Huawei Technology and digital finance sector and Parkway Health. And currently I am responsible for the Netherlands Sichuan Chongqing Chamber of Commerce, Connect Now Club, Connect Now Investment Company. Yeah. And now let's actually have some closer look about what Connect Now is. So where you could tell about the definition of the name, connect, and life is about now. So what we believe is when people are connected, business thrive. When people are connected, all the possibilities is happening. So under Connect Now, our goal is to build the ecosystem, an ecosystem where you can actually have the platform. You can really get to know each other, meet like-minded person, and hearing the insight from the industrial expert. But not only that, once you're connected and meet your partners, we also provide the services from our ecosystem. You can get the services from the investment about to improve your wealth management. You can also get the services from your business sectors, no matter from the marketing research, branding, tax, and legal. Okay, now let's go to one more slide. Yes, so Connect Now for us is we organize yearly more than 20 events. Some of the events is online, and some of the event is just offline. And so really glad to start to meet all the people, all the friends offline back to 5 months ago. So, and within our community, we have nearly 300 close contacts, and our members are growing. And every year we have different types of the business and investment-led working events. And so today is one, and so December 11th, if you don't have plan about the Christmas party yet, follow us, and we really would like to see you at our Christmas party too. Yeah. And we will also soon work more with our partner André, organize the more online live stream and some workshop like this. Yeah. And okay, now let's step into Connect Now investment. So for Connect Now investment partners, before I give each of you some introduction, I'd like to introduce my business partner, Liu Wen. Wen, if you are here, I see you are here. Great. So yeah, she just waved to everyone. Yes.
Oh, good morning, everyone.
Great, Wen. Yes. So Wen is my business partner, and for the Connect Now investment partners. And for us, we are the investment advisor company, and based in Netherlands, but has a connection globally. And we really provide diversified the investment services and the solutions for our customers. And our goal is really become your trusted long-term partners in the really near future. And where you can see from this slide on the right side, what we provide is we do have the real estate bridging loan, and we also have the trading fund. And I believe Andrew later will give us some words about it. And we also provide some real estate investment, the project in Netherlands, and also the workshop, systematic wealth management workshop. Okay, so that is what we do for Connect Now investment partners. Great. Okay, so that's all about myself, the girl from Chengdu, the girl who is reading here to connect. That's all about what is Connect Now. What do we do in the area of the club, investment, and the business? And now let's really step in about the reason we are gathered together. Again, today our topic is about invest now, but how? So normally, and this part, I will always like to give us some snapshots about what is the current investment situation is, what is our concerns. But since we have a very great speaker, and I will skip all the part, I believe he will cover it all. Yeah. And now I'd like to give a few words and introduce our speaker and Mr. André Brouwers. So 志坤，请回到最后一页哈。Yeah. Great. Okay, great. So, and I would like to give some background information about André Brouwers. And so first of all, I'd like to thank our, Connect Now Club member, Shako. Shako, are you here?
Yeah, I'm here. Welcome.
Yes, thank you, Shako. And you are our matchmaker. Thank you for introducing Mr. André Brouwers to us. And so Shako is one of the members of Connect Now. He said to me that, Gabby, I want to introduce you the expert from the investment. And, then we get to know each other already from last year. And the more I get to know André, and the more I'm impressed about his, not only about his, the lifelong, the investment experiences, but also about the way he's highly engaged and the attitude he's willing to share about all of his insight. And with what you may say from this slide is, so first of all, he has been already spent 35 years in the area of the investment. And under him, he actually has been provided his coaching and insight for more than 25,000 of the investors. And himself also have his own methodology and his own method about how can each individual investors to design the investment strategy for yourself. And himself also the 5 years of the winner for one of the largest national investment debate. And so actually that's all from my side, and going to to introduce him. And what you will experience is he will give us nearly half-day workshop and around the topic about if we are investing, like what are the value portfolios, and what will be the right way for you to start to design your investment strategy, and some basic knowledge about upcoming trend for the financial market and how to get yourself prepared. Yes. Okay, now let's everybody and put your attention and also welcome our today's speaker, Mr. André Brouwers. Andrew, the microphone is yours.
Yeah, thank you. That's a long introduction, Gabi. Thank you very much. If you said 35 years of experience, I was wondering whether you were talking about me, but I guess it must be me. Today we have a lot of dear Chinese friends. To be honest, I practiced a bit to say this in Chinese, but unfortunately I didn't make it because I was wondering whether I would say the correct way and have my pronunciation. So to me, Chinese is a very difficult language, and I guess Dutch is a different language to you. So we make it in the middle and we do it in English today, which is a bit different for me as well. Now I see Gabi in the talking in the slides, so maybe you can put up the slides, my presentation. I'll have to do it? All right, okay. Then I have to do the share the screen. This one? Okay. Sharing. Okay, so now this is the correct. New to me, and I should be fine by now. I hope everybody can hear me. So yeah, this is new to me. We use a different software than I'm used to. So therefore, I'm glad that my son, Tom, who was just sharing the screen here, is on the background to assist us. Sunday morning, I did a lot of things in Sunday morning, but never a presentation for a group of Chinese investors at 9 o'clock in the morning. But anyway, I said it's new, so therefore I like the presentation. I like to be part of this event. If there's any question with regards of the content, of course, I like the interaction. So it's no problem at all to answer your questions. But I think it's the best way that I first do my presentation, and then we make a break in the middle, and then we address the questions of the first part, and then I continue with the last part about our presentation. In the meantime, also, I want to thank Jaco, who is a well-known customer of us and a well-known partner, and also, of course, Gabi and Wen for her presentation this morning. And so I think it's okay to start. So this is in Dutch. If you want to study your Dutch, you can read this disclaimer. But I think a disclaimer today, the best thing is be aware this webinar is meant for education purposes only. So examples of trades are meant for illustration purposes only, and you should not be seen as an advice to buy or sell any financial product. So we need to address this as well. Okay, so you see Beleggingsinstituut Educatie voor Beleggers, which basically means we are an investment institute in the Netherlands, and we do education for private investors mainly. We also do sometimes courses for professionals like the Dutch Central Bank or one of the big banks in the Netherlands, which are our customers, but mainly we focus on private investors. Now, what is it that I'm going to talk about? Well, first of all, I want to give you an introduction of who we are, what we do. Then we talk about the challenge of investment nowadays in today's environment, in today's current situation in the financial markets. I go into a little bit deeper and talk about the analysis of financial markets. I also want to present you a strategy, a solution, how to approach investments in these markets. And I also have a golden tip, which I call TIP, a golden tip, which I will talk about by the end of my presentation. Okay, I was introduced already, so you know a bit who we are. I must admit that I like to be part of education because I believe in education. That has also something to do with my background, the way I was raised, born and raised in the south of the Netherlands, where investment at those days in the 60s and 70s of last century wasn't part of my education in these years. So what did we do as an investment institute over the last 10 years? We've been working together with several partners. One of them is the Dutch Telegraph, the biggest newspaper in the Netherlands. We work together with RTL. RTL-Z is one of the business channels on TV. We've been doing presentations. We took people to Dubai for personal coaching reasons. As Gabi also mentioned, we take part of a Dutch debate, the largest challenge for investment professionals. And you can see that as well. All right. Well, most important, I believe, is to bring education forward to especially also younger people. Not only for the elderly people who have the money, have the wealth, and need to protect the wealth and need to raise some returns, but also important for younger people to know what should we do with our money once we have it. And I must admit that I like to do this. I've been doing this for the last 20 years. We've been working together with one of the first internet brokers in the Netherlands, and we've been educating them by setting up an investment academy. Well, this is what people think, so you have an idea about who we are and what our background is. Now, talking about investment nowadays, there's a lot of misunderstanding and prejudgment. First of all, investment in the stock market is scary. That's what a lot of people think. You can lose all your money, or you have to be involved every day, and it will cost you time. And by the way, it's complicated, and you have to follow all the news. And then people say, yeah, but I know a lot of people who lost who lost a lot of money. I said, oh yeah, that's probably true. But sometimes they say, oh, yeah, I know people who made a lot of money, and that's probably true as well. Now, I want to focus, I hope you will focus on not on the misunderstandings and the prejudgment, but be open, think about what investment might do for you, and ask yourself this question: how much do you or did you spend to earn your money? How much time, how much effort, how much energy, and how much time did you or do you spend to manage your money? Think about that. Okay, let's start with analyzing today's financial markets. So part one is about the current conditions in financial markets. Now, first of all, I want to show you a chart. This is a chart going back to 1990 until today. And what you see here is a chart where you can see on a weekly basis the development of the S&P 500. This is an index of the 500 biggest company in the USA, and you can see the development. Now, basically, what we've been seeing here is in the 1990s, the first part here, you can see that the market took off quite severely, quite enthusiastically. Then we had a severe drop. This drop, by the way, was about 50%. Then we had another return, another recovery, and then we had a global financial crisis, 2008, 2009. You can see that we had another recovery, and then we broke out and an uptrend started, and basically starting in 2009, it never came back. There's one severe interruption, which is of course the Corona or COVID crisis, and since then markets took off like never before. Okay, so this is where we are right now. What is remarkable about the behavior of the financial markets for the last 10 years, and especially also for the last 1.5 years, is that we basically went up without any correction, basically without any severe correction. Normally you see trends going up, down, up, down, up, down. But what is remarkable for the last couple of years, that there's basically a one-way up without really corrections. Now, if you take a look on where we are right now, you always have to ask yourself, if I buy a share, if I'm going to be involved in the stock market, what is it that I buy? Now, one of the basic things to think about is about a PE ratio. PE stands for price earnings ratio, which means how much money does a company make and how much, if I buy a stock, how much do I pay? So it's not about if you pay 20 euro for a stock, that 20 is less than 50 euro. No, it's about the company's PE, price earnings, okay? That's a ratio. Now, if you go back and take a look of this one over the last 100 years, you can see that we have periods where markets are really paying a lot for companies, like 20, 25 times average earnings. Now, you can also see that there are periods like in the 29, 39, 49, 79, all with these nines. In all these decades, you can see that people were a bit more pessimistic. So then you only pay 5 or 10 times earnings, which is probably quite cheap, to be honest. Now, the long-term average is about 15 to 17. So if you ask yourself, where are we right now? I will show you later, but this is a chart that tells you about the average. Now, the last couple of years, you've seen a tremendous rise in the PE ratio. And here it is. It now stands around 21, 22. So this is an average for 500 big companies in the United States, okay, which is probably the most important index in the world as far as the stock market is concerned. Now, there is a Nobel Prize winner, Mr. Shiller, and he developed a PE ratio where he is, in this case, is making a correction for the how you say that, for the average inflator adjusted earnings, which he calls them. It's a CAPE ratio, cyclical adjusted PE ratio. Well, whatever is behind there, the chart shows you where we are and what kind of territory are we right now. Are we in cheap, undervalued area, or are we in overvalued area, or even in a bubble, or maybe an extreme bubble, as he calls it? Now, I let you judge by yourself, and you can have an idea of where we are right now. Okay, so according to this Mr. Shiller, which is a Nobel Prize professor in economics, he thinks that stocks are in an extreme bubble area right now. And the market is expensive. You can also take a look on what companies do with regards to price and sales multiples. And as it is mentioned here, we are in unprecedented territory. Okay, we've never been here before. So we are not in cheap territory, we are in unprecedented territory. And you could say the market is expensive. You've probably heard about Warren Buffett. He is the big value investor, and he has a long history. He's even older than me, and then he must be old, I guess. So Mr. Buffett is, I think he's almost 90 years old. But anyway, this investor has a long track record, and he tells us that according to his indicator, where he takes the 5,000 companies in the US and divides the valuation of these companies by, and this is the Wilshire 5000 index, it's another index, he divides it by the gross domestic product being of the United States, and he makes an indicator of it, and you can see it here. This indicator is also in extreme territory. Okay. Now, you can do a lot of indicators. You can take a look of a lot of charts where this tells you where are we right now. Okay, so Goldman Sachs, one of the big business banks in the US, tells you that this non-profitable technology index is shooting through the moon. Okay, it's going right up. And what is this index? It tells you how many companies in the US don't make money but still have a high valuation. Okay, so this is also a bit extreme. Now, what we've seen is that people get enthusiastic. Okay, the more the market gets rises, the more people get enthusiastic about it, and that's a typical human behavior. Okay, and we can see that, for instance, an ARK investment, which is being owned by Katie Wood, which is a lady in the US, very successful with her ETFs and with her fund. She invests in company going innovation companies, being really important to take a look at her portfolio. And then you can see that she pays PEs, for instance, like a company you might have heard of, Tesla. And Tesla, right now, you pay about 200 PE. Okay. Now, there are even companies who don't make money and they are involved in this portfolio. So you can see a lot of names that might or might not raise any questions on your side. But what you can see here, that sometimes, like a company like Shopify, which is something like Amazon, is also being valued right now at around 300 times PE. So this must be companies that will have a high potential for the next decade. And this is the reason why she invests in a portfolio in these companies. Now, to me, a picture like this is about a fund manager. I've never seen something like this before in my life. Okay, so a fund manager where you have a t-shirt, you can buy a t-shirt. Just imagine that you are sitting now behind your screen and buying a t-shirt of me. Okay, that's a bit weird, isn't it? But this is the United States. So this is about maybe a signal of overconfidence. That's it, what it means to me. Anyway, yeah, people get enthusiastic, but most of the time people get enthusiastic at the wrong time. Okay, 10 years ago, when stocks were very low valued, I never heard people talking about investing. Now we have hot numbers, and everyone is talking about investment. So you have to think about that. Okay, and maybe we see the same phenomena in the real estate markets, where 10, 15 years ago, you could buy nice apartments in Amsterdam, but nobody was interested. Nowadays, they fight on the street to buy one. So I don't think that's a good time to be involved in a market like that. Okay. So people take more risk, and even professionals do that. They pile most into risk in a decade, as bears nowhere to be found. Now, a bull and a bear. A bull is an animal. If he attacks you, he will take you on the horn and throw you in the air. A bear is an animal that once he gets you, he will take his claw and puts you down to earth. So this is the reason why we talk about a bull market going up and a bear market going down. Now, there are hedge funds who are willing to take an interest in a falling market. So you can, of course, buy something, then you go long, or you can short something and you go short and you want to see the share price falling. So you sell something at a high level and you try to buy something down once it's been dropping. And the short interest, a lot of players in the market, they did that. But because the market is going up, not a lot of people are involved anymore in shorts. However, what's been going up as well is a very interesting one, is the debt levels. So some people get enthusiastic and they buy on margin. So you even take a loan and you invest, and you can see here what has been going on for the last decades with regards to margin debt. Okay, So that also tells you a bit, if people get enthusiastic, if these margin levels go up, like we've been seeing before the crisis in 2000, 2003, you can see that most of the time people get over enthusiastic again at the wrong time. Okay, so you have to be aware of the fact that this is going on. Now, for instance, something else, Tesla, we've been mentioning it, the biggest company right now, and the richest man on earth, Elon Musk, he owns Tesla. But suddenly, with coming from nowhere, Tesla suddenly is worth as much as the entire oil sector. So the question is that for real? Yeah, and you can see, forgot to put the English over here. Analysts are right now catching up. Okay, they say, yeah, there will be more and more profits of companies, so the stock market will go up probably forever. That's what people say. Now, well, I will tell you a bit about the participation of companies. Now, what we've seen over the last couple of years, we've seen a few companies like the big ones. We also call them the FANG, so the Facebook, the Apple, the Googles, the Microsofts, the Netflix, etc., the most popular big names. There were only a handful of them, and they have a big contribution to the index. So once you see the stock market going up, you see that just only a handful of companies are bringing this index to higher levels, and the big amount of companies are not performing that well. So there is a lot of undervalue in the market, and there's also a lot of probably overvalue in the market. And yeah, as I've been showing you before, profit is a fiction for most companies. So a lot of companies are struggling, and still we have the stock markets at all-time highs. So how come? The question is, it has to do with the participation of number of companies, and also it's a matter of the index. So in an index, if you have, for instance, a company like Apple, it will be, for instance, like in the S&P 500, it will have a contribution of 4 to 5% to the index. So if you have 5 companies with 4 or 5%, it's only a quarter of the index is only being attributable to only 5 companies. So therefore you can see that it is maybe not the real picture that you have for what's going on in the market. Now, you can also see that insiders, which are maybe CEOs, CFOs, who own stock of their own company, are they buying or are they selling? Now, you can see here that the transactions that they do are more on the sell side nowadays. So that might be a signal as well. Now, in the middle, you see Miss Katie Wood. To the left, you see Mohammed Al-Irian, and to the right, you see Scott Minot. Now, to be honest, Mohammed Al-Irian, I'm following him for quite some time. Katie Wood as well, and she's very popular, as I showed you before. But it tells me a bit of over-enthusiasm. That's how I judge the current situation. And all these big titans, as they are called, they want for the next big risk. Now, I'll let you guess what you think and you believe is the next big risk for the market. Think about it. And if we would have a possibility of interaction right now, I would ask you, okay, what do you think is the big risk for the market? But I will tell you, the big risk for the markets is different from these people. Some of them believe, like Katie Wood, she believes that although we have inflation now, she believes that innovation, technology over the years will put pressure on inflation, and that we even go back to deflation over 5 or 10 years, okay, due to technology development. She's very much into technology. Mohammed Al-Irian, he's more like the global macro strategist, and he believes that inflation is something we do need to worry about. Now, this Mr. Scott Minot, to be honest, I haven't heard of him before, but this guy tells something about a big risk with regards to the hacking of the financial system. So he believes that there's a big threat coming from, and in the financial stability in the world, also on the stock exchanges, because of the cyber crime. Now, anyway, I'm first of all, looking nowadays to the euro area, and I also am worried about the inflation. Now, over the last couple of months, I've been telling my audience, although I respect the Fed and Mr. Powell, the Fed president in the United States, and Madame Lagarde from the ECB, the big central banks, although I believe what they say, I must admit that I think they are wrong, okay? Now, why I believe that they are wrong? Well, first of all, I believe that inflation will take off much, much higher than what they've been telling us for the last 3 to 6 months. So already 3, 4, 5 months ago, I told them, be aware, this inflation story that can really take off. Now we see it takes off. You can see here what's going on. So prices go up, 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 and inflation is accelerating. And is that a bad thing? No, a little bit of inflation is not a bad thing. We need that. But more than 1 or 2% inflation, then we have a risk, because soon as we enter a stage where inflation is going up 3, 4, 5, 6%, or even more, that is a problem for the stability in the financial world, and especially also a threat for your wealth. Because if you lose money, basically, purchasing power, that's what you lose over time, with 4, 5, 6% a year. That means if you don't do anything with your money for the next 10 years, then you lose half the purchasing power. So your money is basically cut into half. Although you have 100% in your bank account, the money you can spend is only worth half of it. So inflation is a big threat for the financial stability. And I believe that they underestimated the problem of inflation. And a few of them are really warning against maybe that, we have been too optimistic about inflation. And I believe that. I believe that we are too optimistic. Insiders have rarely been as bearish as they are right now. That's a little bit more. So then you can also see a bit of overconfidence in financial markets. Now take a look on this chart. What you see here is junk bonds. Now, I don't know whether you're aware with the term junk bonds, but junk bonds basically means loans from companies that are not as stable as their competitors. So basically, you can see here that the junk bond yields are plummeting, which means that people are confident to loan to not so stable companies. In return, they get normally a high yield, but in this case, the yield is pretty low. So this is incredible to see that we nowadays accept with a high risk. People say, oh yeah, just give me some interest rates, whether it's be 2, 3, 4%, it's okay. But we have a big risk here. But yeah, no problem. I will accept the 2, 3, 4%. That's fine for me. That's a bit strange. And we've seen it dropping to a very remarkable low rate. So loans with a high risk, people accept really low returns, maybe too low for the risk they run here. Now, another very important thing is that ETFs are extremely popular. It's like a jungle out there. There's so much that you can buy nowadays, and everything within the ETF hemisphere is incredible. Okay, ETFs are basically a very popular product, and I believe it's a great product for a lot of people. However, it also tells me a bit of over enthusiasm in the markets right now. Then sentiment, we can measure that, and you can see here it's extremely bullish for stocks that we haven't seen this before. More money poured into stocks in the past 5 months than over the last 12 years. Bank of America. Come on, what is this? This was already in April, by the way. Take more risk. You can see what's going on here. Risky versus safe assets fund flows. And then coming into the balance sheet of central banks. Now, you have to understand what has been going on for the last couple of years, especially since the global financial crisis in 2007, 2008, 2009. You can see here. Since then, central banks all over the world, okay, have been stimulating, have been lowering interest rates, bringing interest rates down, buying bonds, buying loans from companies, from governments, etc., to stimulate the amount of money being poured into the economy. Now, why was that? Because there was too much leverage in the books of banks, which brought us down to the knees in the global financial crisis. Okay. The answer was, okay, we have a problem with credit. Okay, we have a solution. Just do more credit, bring interest rates down, and introduce more credit and the availability for credit in the markets. So this is what happened. And you can see that the bank balances shoot through the roof. Is this a problem? No, it's not a problem, because the central banks are behind it and the governments are basically behind it. But what could happen is, once interest rates needs to go up to stabilize inflation, central banks have to raise the interest rates. Okay, so bring interest rates up, bring inflation down. But once interest rates are going up and you have a lot of loans out there, then companies, governments need to pay more interest. And once they need to pay more interest, the question is this sustainable? And this is where the risks come from. So we have our credits ballooned to the moon. Interest rates were down to zero or even minus. If you have a lot of debt, that's not a problem, if you don't need to pay interest on the debt. But what happens if interest rates are going up and you have a lot of debt? Then you have a little problem. Right? Just under 2 years ago, the Fed's balance sheet was at 3.7 trillion. That is thousands of billions in Dutch, okay, and steadily declining. Since then, the US Central Bank has printed 4.3 trillion to buy mortgage-backed securities and government bonds at a pace of 120 billion per month. Its balance sheet is now over 8 trillion and climbing. Okay. Now, in the last couple of weeks, the central banks, they have to take action because inflation is running hotter. And now everybody's watching the central banks and say, hey, what is it that we're going to do about it? Now, the Fed said, don't worry, this is only temporarily, okay? We had this COVID crisis. We had been shipping containers from China to US and to Europe, and we have a complete mess here. A lot of bottlenecks in the economy on the supply side. So this will only be temporarily, and don't worry about inflation. It will go over, it will come down. Now, for the last 3, 4, 5 months, we see inflation steadily going up. And now everybody suddenly starts to move a little bit inconvenient and say, hey, but what are you going to do about it? Because are you going to let this implode? So now the Fed chairman said, yeah, I'm getting a bit frustrated because it takes longer than I thought. This is the recent comment. Even yesterday he made a comment. And now you can see that there is a shift coming. So now they need to bring down their stimulation package, and they talk about tapering. Now, tapering means that they will stop buying government bonds and bringing the interest rates down. And maybe they have to make a U-turn now. Now, if they have to make a U-turn, again, the risk is now that they, one, being behind the curve, as they call it, so that they might be too late to adjust. The second risk is now that once interest rates are going up, I told you about the higher level of debt in the economy, that will bring the economy down and maybe also bring, of course, the stock market down, maybe might also have an impact for real estate, have definitely an impact on bonds. So this could have a big impact. Okay, this is the situation right now. Now, strange enough, if you take a look on bonds, this is where I believe is a big bubble in bonds. And in bonds, you can see that what people earn on a bond, on a loan, basically you loan to a company. And basically, if you take a look on what's happening here, you get a very small return. And even the return nowadays is minus. So people are investing in bonds. The big institutions like the pension funds and the institutional investors, they need to be involved in the bond market because there is definitely a rule from the government pushing them into bonds, but of course somebody has to buy the debt. So it's very nice. You make a rule here. You tell the institutions, hey, you have to buy these bonds because you need to be a prudent investor, okay? And whatever happens with your returns, we are not interested in, as long as you buy these bonds, because somebody has to buy the loans. We need to make more credits, so therefore somebody has to take it on their books. Now, even if you go to a bank or private wealth manager nowadays, you can see in your portfolio, and I will talk about it in part number 2, what it means for your personal investment plan. Anyway, this is a very interesting chart because it tells you how crazy the world is nowadays, that people accept a minus on their money. And there's also a big risk. If interest rates are going up, this will be a nightmare, okay? Because if interest rates are going up, bond prices are going down, okay? And severely down. We've seen this before. In 1994, I still remember there was one of these years where suddenly there was a big increase in interest rates, and then bonds went down like 10, 20, 30% in no time, okay? So this is where the risk is. And where this has all come from, one of the reasons that we see these interest rates and this inflation discussion getting hotter and hotter these days is because of commodity prices, okay? Now, there are, of course, all kinds of models and what could be a possible impact. Now, people say if interest rates going up for half a point, half a percentage point, it could also mean that, for instance, the big NDX, which is the Nasdaq index, the technology sector, it could fall by 20%, okay? So there's a severe impact. You have the theoretical impact of instantaneous rise in bond yields, as it is being called. And here you can see if we go up 1 point, 100 basis points, it's called 100 plus 100, which means 1% up in interest rates. It could have a severe impact, because if the market is valued like 30 times PE, and the technology sector nowadays is above 30 PE. So if you pay 30 PE, if this is the valuation of the market right now, and you get a 1% rise in interest rates, it could mean that you have a drop of 20-25% now, okay? This is a theoretical model, okay? But it's how people look at it. Now, if you take a look on where I believe where we are, I think we are here in the public greed area, okay? And the delusion, and there is a new paradigm, and et cetera, et cetera. And I believe we are somewhere here nowadays, okay? History will only tell if I'm right or not, but there are so many aspects I can think of right now that okay. I can think of that we see so many extremes, okay? So if you see the extremes, it means that you have to be a little bit cautious about what's going on. And whether we see extremes in real estate, whether we see them in bonds, whether we see them in stocks, yeah, we see a lot of extremes in all these asset classes. Now, one of the famous years in the past was 1929. And take a look on what happened in these days. And you could also take a look on the roaring 90s, the last century. And yeah, I think there's quite some resemblance. And again, this 2021, it can still go up, and it can even accelerate up. So we could also have 1 or 2 very interesting years where it's even accelerating for more returns in stock markets. It could very well be. All I'm telling you is that there is a lot of enthusiasm in the markets, and that's normally, in historical perspective, not the best way to not the best time to participate. Okay. Now, this is how it looks like in 1929. Exactly in 1929 and nowadays. So what we're talking about 92 years ago. As of today, it's really interesting. Exactly today, 24th of October in 1929 was a big crash in Wall Street. Now, how do I judge the situation? I think nowadays too much mass behavior and the public is moving into the market, and making a return looks like it was very easy. And to me, it was never easy for making a return if you take a look at risk return. So why is it suddenly now? Why is everybody suddenly a pro? To me, certain pockets of the market are overvalued. On the other hand, certain pockets are undervalued. And I think a very important driver of the last 10 years in stock markets and real estate, etc., is preparing for a U-turn. And we're talking about the central banks. And they are getting squeezed a little bit now. And I believe inflation is here to stay and not temporary. Now, going back in my memory, in 2009, I was part of a Dutch television documentary. You can even look it up on YouTube, I guess. In those days, I said to the public, hey, everything is so cheap. Why is everybody sleeping? Why is nobody interested to invest? Why is nobody there to buy? Because it's all cheap. And on those days, we had a completely different situation. Okay, so it's always the same, from undervalue to overvalue and back again. This is how the public acts, and I think you have to be aware of that. So Warren Buffett talked about fear of missing out, not being part of something very enthusiastic. And people start being interested in something because it's going up. Not because they understand it or anything else, he says. But the guy next door, who they know is dumber than they are, is getting rich and they aren't. And their spouse is saying, can't you figure it out too? It's so contagious. So that's a permanent part of the system. This is what he is talking about, and I totally agree with this. Okay. Then another expert says, for the great bubbles that we had by scale and significance, we also notice that they are accelerated late in the game. So it's always the same, like it's going up, 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 and suddenly it's going like parabolic, okay? And so it's getting more and more expensive, and people get more and more enthusiastic about it because nobody wants to miss it. It's a bit like that. So then you see it in overdrive. So people accelerate and being part of it late in the game, and had psychological measures that could not be missed by ordinary investors. Economists are a different matter, they say. The data, like today, is always clear. Okay, the data is clear. I showed you some data, but it's not so convenient for people to tell, hey, now better not participating because it's too much. It's not the right time to enter. But if you have to make money because you are a fund manager, or you are a wealth manager, or you are whatever you are, it's not so commercial to say, no, not now. Sorry, man. Sorry, sir. Maybe at another time. So for the investment industry, it's not so, so straightforward as sometimes as it is. Now, I have to tell you one thing and one thing more. This is John Maynard Keynes. He's one of the big economists of the last century. And he said something I can really stick to as well. Markets can remain irrational longer than you can remain solvent. So let's be clear about the following. We see an irrational acting market maybe, and this can be long lasting. So it could go up for 1, 2, 3 years. I don't know. It could very well be. So we have to be aware of the fact that nobody, whether you have 35 years of experience or 100 years of experience, nobody knows how it really will end. All I can tell you right now is that we have to be aware of the fact that we are in an environment where it's an explosive environment, let's call it that way, okay? Especially with regards to inflation, interest rates, because we took a lot of debt in the world, and because of COVID, it was even increased more. So we have a very unnatural behavior of the central banks who brought us into this situation. They had to, because there was a problem in 2007, 2008, 2009. If they didn't fix that one, the whole system would have collapsed. Okay, so they choose to postpone the problem, manage it, whether that was right or wrong, that's okay. but they managed it, but the debt went on and on and on. And yeah, you can see, as a lot of you probably are aware of, with a problem, I think if we talk about China and Evergrande, you can see what a problem in the end will lead you to. I'm not an expert on China. I study what's going on there. I think it's very interesting. I think for the world, it's very important as well. It's the economy number 2 now, and probably soon it will be number 1. So I think we have to look into it. But it tells you, and I think, by the way, the Chinese are managing it now, maybe a bit late, but they are managing it now. And maybe also the hard way, if you take a look on what they do with Alibaba and Tencent and blah, blah, blah. But I think in the West, there is an even bigger problem. And the question is whether they are willing to manage it the hard way as the Chinese do. So, yeah, to me, it's an interesting world, as it was always and always will be and has been. And there will always be risk. And there will always be, that's a very important one, there will always be opportunities. And I think there are a lot of opportunities as well. Okay. So maybe for now, it's a good time to have a little break and see if there are any questions. Okay. So this is part number 1. I have 2 more parts for you. So this is part number 1, and I will take any questions if you have. I don't know how we're going to organize this with questions. Maybe my son Tom can help me, or Gabi can tell me if there are any questions that people want to talk about.
Indeed, I think people are all fully in your presentation. And of course, like there are also, we also collect a few questions before the event prepared by the audience, and we can type it in. Yeah. Okay, I can also quickly speak in Chinese, and to make ensure like everybody knows that now is people can raise some spontaneous or prepared questions. 好，各位学员们哈，然后刚刚呢，老师现在讲到这个章节之后，如果呢就是你们呢给到我们一个短暂的一个提问的一个机会哈，你们现在有没有一些相关的问题可以打到我们的留言板，或直接举手，或直接打开你的这个取消静音哈，取消静音，然后呢和老师直接沟通。 有吗？好，没有对吧？暂时没有哈。OK， 好，待会我们的话会有这个大概30分钟的一个 Q&A 的时间，大家提前准备一下问题哈。OK，up to now, I think we haven't received any questions.
Okay.
So everybody is having like a study mode. Great. Yes.
Good. Then we're gonna go into part 2, and I hope the situation is clear. And hopefully I did not make you scared, but I think I have to be realistic, okay? And I want to be realistic and transparent about these things. Anyway, so let's continue into part 2. Now, the question is, how should you behave? Because there is a challenge. The challenge is nowadays, if you don't do anything, if you not invest, and inflation is going up like 3, 4, 5%, like it has been over times, always more or less for the last 50 years. If you don't do anything with your money, you run the risk that your purchasing power is going down. So more or less you are forced into investments, whether you like it or not. Because what is the alternative? There is no alternative. TINA, T-I-N-A. There is no alternative. Now, if there is no alternative, because you cannot go to the bank and say, hey, give me 5, 6, 7, 8%, and I'm fine. To hedge my inflation risk, it's not there. Okay, the most how you say, the most secured investment would be a bond, a loan of the government, for instance. But the government offers you minus 0.5% interest rates, minus 0.5 interest rates. So if you buy a bond, a loan for the government, and the government tells you, in 10 years' time I pay it back, then it's very secure because the government promised you to give you your money back. But if you have to accept minus 0.5% and inflation is running at 5%, then you miss 5.5% each year. So if you do that for 10 years, your purchasing power is gone. So that's not an alternative. Yeah. So then you say, yeah, but I don't want to run the risk of a lot of, if you tell me, Andre, the market is overvalued. And if I don't invest now, then I'm getting squeezed by minus 0.5, minus 5% a year. So I need to look for a very interesting investment And do you believe that there is a possibility? And I say, there's a tremendous opportunity out there. So yes, there is enough opportunity. Okay, but you have to be aware on the background that what is the situation that we're currently in. Okay, so now I'm going to try to explain to you where the opportunities are and how you could manage your money and also manage your risk, because this game is only about risk management. And this is what I teach a lot of people. This is my favorite topic, is like how to manage your risk. Okay. Now, tell you a little bit about my background. I was raised in the south of the Netherlands, in an area where a lot of people were working hard, basically in coal mines. This was the area in the 1960s, 70s when I was raised in Limburg in the south, near Maastricht. Now, my father had a grocery shop, and he was doing one thing with his money, going for an investment, going to the bank, put his money in an investment, sorry, not an investment account, on a savings account. And this is what he did, okay? Just put money in the bank and receive some interest rates. And in those days, you had a little book, a yellow book, and they wrote down what your money was and the interest rates you received. So that was the old-fashioned way. After 30, 40 years working hard, I thought that my father thought that he was rich because he saved his money, but he never learned to invest. Now, in the end, what you end up with is a pension that has nothing left from purchasing power. Even in those days, when he received interest rates, inflation was even bigger. We all know that. With €100,000 or $100,000, 50 years ago, you had a fortune. Nowadays, with €100,000, can you buy a house? No. With €100,000 50 years ago, you could buy a villa, maybe probably two. Okay, so this is what inflation does over time. Now, I was never raised with the consciousness of, hey, you should invest your money. They always say, no, take a good job, work hard, and save your money. Now, they never told me anything about investments. So now I teach my children, and I have 3 of them. One of them you saw. I have 2 nice daughters as well, Nina and Julia, and I have Tom. And I tell them, listen, if you want to make progress, you need to invest as soon as possible. Once you earn money, you need to invest. But how to invest? And I told them, loving this one is a losing game. So the reality check is ahead. Think about the following. If you would have 100,000 right nowadays, and for the next 30 years, you would make 1% or you would lose 1%. In 30 years' time, this is the difference. So in the beginning, 1 year, it's not a big thing. But over time, if you make 1% or you lose 1%, and here the difference is only 2%, it will have a huge impact. Now, just imagine what would happen if you would have 5% up or 5% down. It would be an incredible one. Now, over time, losing the game by saving, there are some champions as well. And who are the champions? These are the champions. For the longer term, stocks had been a tremendous return. And not only over the last 30 years, we can go even more back. And you can see what happened in the technology sector. This index was even incredible over the last 30 years. This is what happened for your money. So even if we had these crazy times like in 2000, 2003, or the global financial crisis, 2008, 2009, for the last couple of years, we went up really parabolically, okay? But over time, the market went up and you would have scored tremendous results. Also in the Dutch market, this is for the last 5 years. We've seen here the Corona dip, and after that, the market took off. Okay, still going up. Euro stocks, still going up. Last 3 years. China. China is one of the markets that went down for the last couple of months, years you cannot really say, but we are back, I believe, at a very interesting point. If you talk about overvaluing and undervaluing, to me, China is one of the undervalued, one of the possibilities. Because if I take a look at a chart, we came back to the level where we've been in 2019, where we've been in 2018. And this tells me that this is a very important turning point. So this area is definitely a buy area to me, okay? So I'm involved, I'm investing in the Chinese stock market because of the fact that I like to buy when everybody is pessimistic, when we had a drop like 20, 30%. Because over time, I still believe that there's a lot of potential in China. Yes, to us in the Western world, there's also maybe a risk involved because we never exactly know what the Chinese government might do next with regards to being involved in the strategy with regards to, for instance, companies like Alibaba, Tencent, etc. But I do believe that after a drop like this, I think the potential is still there. It has been, it will be, and it will be in the future. So after a drop like this to me is something interesting. So I bought at this level here because this is a support level. It has everything to do with the top levels of the last couple of years. So I take a look on charts to see whether the timing is right. I tell you a bit later about this as well. Now, volatility is going down, 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 which tells me confidence is going up, up, up. This is volatility in the Western world, okay? It's going down, as you can see. Now, where is there money to be made? Where's the opportunity? One of the pockets in the markets where there is opportunity, I believe, is in the value investment scene. Technology has been going up, 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 and will be there. Technology, don't get me wrong, technology is the driver for the next decades. Okay, so do you need to be involved in technology? I do believe so. But in the big companies, there is definitely some overvaluing there. So I believe that you have to look into certain areas where there is opportunity to invest in. And also in the value scene, there are a lot of companies that are undervalued due to COVID as well. You get a buying opportunity longer term. Okay. Now, one of my favorite asset classes is emerging markets. So I believe over time, and we talk about 10, 20, 30 years from now, I believe emerging markets is the place to be. The reason is very simple. Emerging markets have the opportunity to grow in their economy. I think in the Western world, like for instance in Europe, we still have a huge problem with debt. Although we have the euro and we have Europe, we are not one. So I think there's still, over time, there's still a risk of disintegration, of more pressure on the system. And the growth potential in a world where you see a decrease in participation, I believe that there's more risk involved and less growth potential. But there are a lot of economies in the world that still have growth potential. So I'm in longer term, I'm investing in emerging markets. And the valuation, the PE ratios, the valuation of these markets is lower than the developed world, which is also a bit strange. So you have more potential and you have lower valuation. That to me means an investment opportunity.
Sorry, Andre, and I have like a very basic question. And could you go to the slide above? Yes, and you are talking about emerging market, right?
Mm-hmm.
Yeah, could you give us, at least give to me a little bit more introduction about emerging market mean?
Well, basically emerging markets are markets like Southeast Asia, like Vietnam, Indonesia, India, Brazil, Latin America, all these markets, these are markets that are not as developed as the Western world, like Europe and the United States. China is being part of emerging markets as well as an index, although it's a very developed country, but we still see it as an emerging market, okay? So this is where an index is. So if you want to invest, there is an MSCI value index, EM, emerging markets. There are all kind of ETFs available where you can, so funds available where you can invest in, and there's a whole bunch of them. Maybe at another time I can prepare a list and I can share it with you. But my point is this, that to me it makes sense to invest in an area where there's still potential to be. Okay.
I got it. Thank you for this.
Yeah?
Thank you.
Right.
Yeah.
Okay, now it could be that you have missed opportunities, but I would
say. Sorry, Andrea, this is Yuqing. I have one small question. You mentioned that in China, you see a potential to grow, and you are trying to buy some stock from China, and I would like to know which area you buy it, and is it technology? Because you really like focus on technology. You believe that in technology we will grow a lot.
Yeah. Well, for instance, if I'm investing, for instance, in Tencent, I do that on the Dutch stock exchange. There's a company called Proces, and they have a holding company, and they invest in Tencent. One of them. They have a couple of other companies as well. But for instance, Proces and Tencent came down. But if you take a look at the valuation of Tencent and you compare that to the US technology sector, there's a huge undervaluation as far as I'm concerned. Now, the big question, of course, that we all ask is, how far will the Chinese government go by interfering in the strategy of these companies? This, of course, is a bigger risk. This is also the reason why we have an undervalue of this company compared to the sister companies in the US. So I will definitely look at the technology sector, like the Tencent, the Baidus, and the Alibabas, etc., who came off, the big companies. And the way you could do it, the way I do it, there is a Chinese 50 index. So you buy an index, you buy a basket of companies, not necessarily go for one of them, but I would say just invest in a basket of companies, and you have these ETFs, which is a basket of of stocks that follow an index. They track the index, and I would buy it by buying something like that. Okay.
Okay. Thank you.
Okay. Yeah. So if you missed it, I always say, don't worry, you still have time before getting old. And one of the biggest assets you have as an audience, what I understood, you're all young professionals. So you have a lot of time, okay? So this is your biggest asset. And so therefore you have to think about your strategy. Now, let's go back a little bit now. I was struggling a bit when I made this presentation because I thought, okay, these are younger professionals who make a nice money and they have still 30, 40 years to go before they reach their pension, or maybe they want to retire. So how would I invest? So I have to tell you a bit about the basics behind investing. Now, and I have a different approach to this, but first I have to tell you what is the regular theory. So I will share with you the regular theory, and then I will give you my interpretation of how I would deal with it. Okay. Now, this is what you would normally, if you go to a bank or an asset manager, they will tell you, listen, this is all about the asset mix. Okay, don't put all your money into one stock or in a basket of stocks. No, you have to diversify. So you maybe buy a bit of gold, alternatives, the emerging markets. You can do fixed income. Fixed income is bonds, okay, the loans. To me, that's a no-go area for now, a no-go area for bonds because it's not attractive and there's huge risk involved. But this is what they traditionally will do. Because why? Well, bonds over time, at least you get your money back in 10 years' time. But the problem with getting your money back is that my money, albeit in a nominal terms, it will be my money. So if I rent out, if I give the government a loan of 1,000 and they will pay it back in 10 years' time, I will still have my money. That's what they say. So there is no risk, they tell me. Yeah, but the question is, what can I buy in 10 years' time if I have a minus interest rate? So a lot of fund managers in their asset mix are forced into this area because the government tells them they have to be prudently investing for clients. And this is the reason why a lot of people have bonds or fixed income in their portfolios, which is to me a crazy idea at this moment. Okay. Now, anyway, so we have US equities, international equities. So this could be an asset mix example. Now, I will leave this here, but diversification, why you should diversify. Everybody can understand why it is important. Okay, so you can include positions in different industries, asset classes, different financial instruments. But the core aim of diversification is to improve your risk adjusted returns. So which is the degree of risk you have to take in order to achieve a profit. Now, if you diversify, and we can all understand why it is important, I guess, it makes sense to do this. However, my experience over the last 35 years is that although you diversify, there will be a problem if the markets are going down. And the risk now is bigger than they've been before. Why? If you go back to this area here and you take a look on, for instance, if 30% or 40% of your portfolio is fixed income, if we now have inflation, interest rates go up, bonds will go down. If interest rates go up for 1%, a 10-year loan will go down 10 times 1%, which is 10%. So 1% rise in interest rates, portfolio fixed income, minus 10%. In the past, over the last couple of years, interest rates went down, 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 down. Bonds went up, 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 up. Because if interest rates are going down 1%, your fixed income portfolio goes up 10%. So there is this correlation. So we see interest rates going down, fixed income going up, which was great. But now we are here near zero or below zero. The question is, how much further down can bonds go? Probably not that much. So now you have these high returns on your fixed income portfolio. Now, if interest rates are going up, bonds will come down. So diversification won't work this time. And if 30 or 40% of your portfolio is being fixed income, you will have a fixed problem, I would say. Now, if interest rates are going up and we have this huge valuation on the equity side, you would have a problem with your equities as well. And then you have cash, which doesn't bring you anything. And then you have gold with a big question mark. What will happen to gold if interest rates going up or inflation? Normally, gold would go up with inflation. And alternative strategies, it all depends whether you have them in your portfolio, yes or no. But alternatives will be the only asset class who could really protect you when the market is going down. So a lot of these portfolios from investment managers and from wealth funds and banks, etc., I can see is that there is a huge risk involved. So everybody says, yeah, but I have a big and a good diversification. And it worked over the last 5 or 10 years. I said, yes, of course it worked because interest rates are going down. But if we have a different environment, this whole portfolio is at risk. Point. So this will not help you to manage your risk if markets are going down. This is what we've learned in 2008, 2009. This is what we've learned in the internet bubble, 2000, 2003. And a lot of people, since they didn't saw this happening over the last 10 years, they all sleep. They say, oh yeah, my wealth is going up, up, up. I'm all fine. I have real estate, I have bonds, I have stocks, everything is fine. Yes, of course it's fine. But if the environment changes, and we are maybe in a different environment right now than we've been for the last 5 or 10 years, your diversification strategy won't work. Okay, this is what I tell people to wake up, because diversification is fine and it's all logical, but it won't help you once markets change their course. Okay, so this is one of the big concerns that an investor should think of. Now, I will leave this for now, but this is just to give you an idea about a conservative portfolio. And you can see if you go to a bank and say, I want a conservative portfolio, then what you will get is 14% in, for instance, if you're an American, they will give you 14% in US stock, 50% in bonds. So 50% is in fixed income. And even if you have a balanced portfolio, or even if you say we need a growth portfolio, they still put 25% in fixed income. And then only half of that will be in shares. Okay, so what I'm telling you is these are all nice figures, but these are all figures in a different market environment than we have right now. So a lot of people are sleeping, as far as I'm concerned, and they still think this will help me in the next crisis. This won't help you in the next crisis. Okay, it will be a risk. I say bonds are a time bomb in your portfolio. Okay, well, I can share this with you if you want to have, if you don't understand exactly what bonds are, and if you say, but how come that this relationship with interest rates and duration of a certain bond, that there's a more to tell you about this to explain it to you, but I think for now it's fine, okay? But there are on the internet you find these pictures, so I've copied a few for you. And this is basically, so if you are 30 years old or 40 years old, you take 100 minus your age, and then you get your investment allocation. And this is basically what it is. This is basically what people do. Again, I'm not a fan of this, but this is what's being told. Okay. So just imagine if you are 50 years old, 100 minus 50, so 50% high risk returns, investments like stocks, mutual funds, etc. And safer investments like savings and bonds, and so you do a mix of this. Now, again, this is a bit a course in investing, starting from a basic level. And my challenge here for you today is, I have no clue what your level is with regards to your knowledge. So I can go in very deep into details, but that takes time. So for now, I just go on. And if you don't understand what all of this means, then it's maybe a good idea to take a course somewhere down the road, or buy a book on it, and develop your knowledge with respect to investing, because I believe it's very important for the years going forward. And if you say, oh, this is all too complicated for me, yeah, I better buy a savings account or whatever. Or if you think, oh yeah, I put some real estate and think that your risk is gone, forget it, okay? There's nowhere to hide. There's nowhere to hide for this environment. So you run a risk. And one of the things, maybe I can address that right now. If people talk about real estate and financial markets, there's a huge difference. One of the things I can learn you is how to manage your risk when you have money involved in the stock market, because there are instruments to cover your risk. Simply insurance policies you can buy. So you buy a stock, you buy your insurance, and your risk is definitely not bigger than this, okay? You put a floor to your risk. Now, if I buy real estate, there is no floor. Real estate can go up and down, can go everywhere. Stocks can go up and down everywhere, but if I put a floor, my risk is controlled. Now, again, I told you, this is all about risk management. So one of the things I like about the financial markets, about investing in stocks, for instance, is that I have the flexibility to do a tailor-made strategy. I can say I want to run this risk, or I want to run this risk, or I want to run this risk. I can do it myself. So this is what I teach people. Manage your risk with the right instruments. Do that efficiently and effectively. That is what it is all about. I have an opinion about the future, but I have no knowledge about the future. Basically, I don't know nothing. What is it that I know about the future? I know nothing about the future. You? Do you know how the future will go? Of course not. This is out of our hands. So the markets will give us hopefully some opportunities, but the only thing that I have in my hand is to manage my risk. So this is the really and most important factor that you need to address. Okay, and this is what I try to learn people and try to help them with, to control their risk. Now, if you invest in anything else, whether you invest in a company or you have your own company, how can you protect your company? If suddenly a virus arises like COVID and you have an hotel or you have a restaurant, boom, it can drop. There is no protection. There is no level of protection you can buy. Forget it. If you buy real estate, there is no level of protection. It can go everywhere, okay? So this to me is a concept that I really like, and especially also the following. In the financial markets, I have the possibility to press one button and I have my money back. So there's a huge flexibility with my money. If I want to step out of the game, I press the button, I have my money on the table. If I go into a company, if I go into real estate, I want to press a button, there is no button. And you always need to look for another buyer for your property. If everybody is enthusiastic, that's not a problem. You can sell it easily, okay? But once you want to get out, try to find a buyer, okay? This will be a problem. So therefore, I'm a huge fan of flexibility, of liquidity, and about risk management. Okay, so this to me is really important. So yes, you need a certain amount of money, but you need this understanding as far as I'm concerned. Okay. Now you can learn all of this, how to pick a stock, how to whatever. And there's a lot of information available also on the internet. Okay, you can find a lot of information. But what they don't tell you is how, once you have this knowledge, how to do it in practice. Okay, what are the lessons of the last 30, 40 years? That is difficult to find. You can explain a bit about the PE ratio and how to select a stock and how to diversify a portfolio and what are bonds and what are stocks. You can find all of this, and please do, because you need to have this knowledge to have a little bit of understanding. But what I'm trying to do here is to help you moving through the jungle, because there is a jungle out there and it's a dangerous one. The central banks created an incredible jungle for us. Okay, so there's a lot of risk. There will always be risk. There will always be threats. There will always be opportunities. But the question is how to survive. Okay. So this, again, I want to share with you, and I won't discuss it right now because it takes too much time. But this is all what you can do. What kind of stocks could you buy? What is dividend? What is defensive? What is growth? What is cyclical? What are the blue chips? What should I invest in? Etc. etc. But there is no easy solution. There is an easy solution. You go to the bank, and in 5 minutes you go out and you have a diversified portfolio and say, okay, bye-bye, see you. Yeah, but this is not about investing. I've seen these accidents before. I've seen the pale faces of people who sold their business, went to a private bank, received a nice diversified portfolio, and 3 years later down the road, they were down 30, 40, 50%. And then said, yeah, but why the bank didn't protect me? Why the bank didn't interfere? Why didn't they sell when they saw there was market going down? They won't do that because they believe for the longer term, markets will go up, 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 because that's what the statistics say. But we changed. There's a different environment now. So you have to be aware of that. This is important. Because the bank will tell you, yeah, but stocks are for the long run. This is a great book, Jeremy Siegel. It's a professor in Pennsylvania. And he tells you stocks are for the long run, which is true. It is true. Because he went back and made a simulation and said, what would have happened if you would have $1 in stocks in 1800? And you would have kept it for 200 years. You see this curve. $1 would have been 1 million. Really? Really? How come? This is about compound interest. I will show you later. So $1 went into 1 million. Great. But this is for 200 years. Now, I know for sure I won't live for another 200 years. And probably, although you have a big asset, which is time, probably not for 200 years either. So now, if you take a look on what would have happened if you would have put your money into bonds, it would have grown also decently because you will receive interest rates over the last 200 years. Interest rate was positive. So if you put your money into a loan, you get your interest rates, and $1 would have changed into 1,642. If you would have put it into a savings account, you would have made $275. Yes, so saving would have bring you something because saving rates would have a compound interest as well. If you put money into gold for 200 years, yeah, you would have kept your purchasing power in a reasonable way. But if you would have sticked your money into cash, your purchasing power is gone. Literally nothing is left. So this is the big case. Why would you and should you invest in stocks? By the way, if you would look for the return on real estate, it would have been anywhere in the middle between stocks and bonds. Okay, so the best place for your money over time would have been stocks, 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 stocks. Okay, the average yearly would have been 6.7%. Now, if you start in 1800 and you take 6.7%, 6.7%, 6.7, and you would have stick to the stock story, then the compound interest, like Albert Einstein tells you, is the 8 wonders of the world. He who understands it earns it, and he who doesn't pays for it. That's definitely true. Now, just to show you what the power of compound interest is. Now, today you have 1 cent. If you would double your money each day from 1 cent to 2 cents, and then from 2 to 4, 8, 16, 32, etc. You, after 30 days, you would have 5 million. Okay, so this is crazy. Even if you have this compounding interest thing, it's incredible. Now, again, I don't know who you are, what your average age is, but if you are 25 and you would start with 1,000 a year, or you would be 35 or 45, and you would have made 7% a year, this is what where you end up with. So see the huge difference if you would start at 25 or at 45. There's a huge difference. It's 1 million difference between these 20 years. This is the compound interest thing. So the sooner you start with your strategy, probably the best returns you will have over time. So you would definitely need more time. Now, my whole thing is, this is all true, but I will show you later on a chart where I will show you that in 10 or 20 years different time decades, 10-year decades of 10 years, you can see different periods and you can see different stories. Okay, so you have to be aware of the fact that although the 200-year chart of Mr. This one of Mr. Siegel is right, if you zoom in into different periods for 10 years or 20 years, you can have a completely different story. Okay. All right. Now, to understand this, if you want to double your money, use the rule of 72. So 72 divided by your interest rate or whatever you will have, your return. If you say, I make 8%, then every 9 years your money will double. If you say, I make 20%, then every 3.5 years your money will double. Okay. Now, nowadays you find these charts. It's all funny to see, and they say, yeah, if you have 1,000, you put 25%. You're going to diversify. You buy McDonald's and Coca-Colas and Pepsi-Colas, or you do like this. Yeah, it's all great. It's all fine. You can do that with 1,000 a month. And start accumulating. Because what I tell young people, also students, I tell them, listen, as soon as you receive money, okay, take 10% of your salary and invest that in a monthly way. Monthly buying. For the next 20, 30 years, you're going to accumulate your wealth by just buying maybe something like this, okay? And this will work over time because you have 30, 40 years, 50 years to go. But what happens if you have your company and you sell your company, you have 1 million or 10 million or 100 million, whatever you have, and now you need to invest? What will happen with this money if suddenly the market goes down 30, 40, 50%? And it takes time, maybe 10 years before you go back, or 15 years or 20 years before you come back after a drop like this, because this is also history and also statistics. Then you need protection under your wealth. This is why I teach people this idea, this concept, okay? Think about it. Diversification won't work anymore. This is my message to the world. Diversification won't work in the future. Okay? You need to protect yourself. Now we see all of this. Okay, where should I invest in, André? I said, I have no clue, but maybe in things like this, artificial intelligence, probably, circular economy, probably, transport, healthcare, logistics. There's so much to do. There's so much potential to invest. But the difficult thing is, what will be the sector that is going up? And nowadays you have a second problem. Because of TINA, there is no alternative. A lot of money of people is invested in financial markets, and you see these huge valuation. So if there's something out there and they say, this is a great company, Tesla is going in, and everybody jumps on Tesla, everybody jumps on NIO, and then suddenly all of them is like, and you get a valuation which is through the roof. Now, if you are a little bit late and you enter at this stage, you have a huge risk. Yes, there is potential in this company, but the valuation is like 200 times PE or 300 times going forward. So the opportunity is already gone. Okay. So yes, it makes sense. Think about all these sectors, but the valuation is already up there. Nothing is cheap. Okay. All right. So maybe we take a little 1 or 2 minute break, and then we go for maybe the idea of a strategy, and maybe we take some questions if there are in the meantime.
Thank you, André. We do have questions now in the chat window. Can you see them?
To be honest, no. Maybe you can.
Maybe Tom can help a bit.
Yeah.
We have several questions here.
Yeah.
First one is from Flora. She said, hi, André, quick one. Please advise what type sector of the Chinese stock would you be interested in? And are you referring to Chinese stock IPO and in China or NASDAQ?
NASDAQ, yeah. Well, again, I'm not an expert on China. Okay, that's my first point. All I can say is that I'm getting interested after a 20-30% drop in the market. If I believe that China is still there and will be there for the next, whatever, 1,000 years probably or more, I have no idea. So China is not gone, the potential is not gone, but the market came down 20-30%. So if I would go back in time, in 2-3 years from yesterday or the day before, people were saying, yeah, you have to invest like, these are great companies or these are great countries to invest in. I said, okay, I take your point. I'm not the expert, but I hear what you say. And then suddenly the market crashes for 20-30%. And then everybody says, oh, no, don't touch it. It's not interesting anymore. That is a sentiment I like, okay? So if I see something like that, which I think is now the case in China, I'm getting interested in. This is all I'm telling you, okay? But then my other point comes. I'm not the guy who says, this is a great country, this is a great thing, I buy it. I will always use this mechanism, okay? So I don't like when people think, oh yeah, I buy this, I buy that, and then my problem is solved. This is not the way it will work, okay? I believe that you need this protection always, and definitely in this environment, whether it's China, whether it's US, whatever it is, whether it's a great potential or not, I will always use my money in this way. And I will explain to you in my third part, why is this important, okay?
So are you happy with the question? Answer, Flora?
I don't think so, because I didn't address her question.
Actually, she has another question.
Okay.
Said,
smart questions though, but I mean, there's so much more to say. If you go into the problem that we have with NASDAQ and with the shares of Chinese companies and what the Americans are planning to do, just think about what would happen if we have a conflict on Taiwan, okay? Okay, what will happen? What will the Americans do? What will they force things? There will always be a risk, okay? So it's not I cannot give you an easy answer on this one.
Yeah, clear.
Okay.
She has another question is, what do you exactly mean on the real estate industry of fluctuation? How do you see the relationship of the interest rate impact on real estate in the coming years? Mm-hmm. It's from the same person.
Yeah. Okay. Right. What we need to understand is, if interest rates are going up, costs will go up as well. Now, there's one challenge here. If you are an average worker and you need to pay your rent on your house, okay, and interest rates go up, this will have your costs will go up. But the question is, will your salary go up at the same level? There is a certain how you say that, a certain level where people can pay interest rates and can pay rent on a mortgage or on a house. So if this relationship is now switching, that will have an impact. And yes, if inflation goes up, interest rates will go up, and if inflation goes up, probably real estate prices will go up. However, the question is, who can afford the rent? So if there's a level of a plafond, I would say in Dutch, I'm looking for the English word, but if there's a ceiling to what people can afford, then there is a natural maximum to real estate as well. Okay, so this is one of the points. Now the other point is that if inflation is going up, interest rates are probably will follow. Okay. The question is again, what will be the impact of debt in the world? What will happen there? And this is a threat. So it could easily mean also that people, if you pay more for your rent, for instance, or you pay more for your groceries, then you cannot afford the same on another side. I mean, there is a maximum that people can afford because this is what you have. And if a certain chunk is taken out in one sector, then you have less in the other sector. I think there's also, I think that was one of the reasons what we saw in China is also the overcapacity. Everybody got too enthusiastic. Yeah, there's money to be made in real estate. Let's buy, let's build more, and suddenly there's overcapacity. Debt is involved. There's a problem, and then the whole system is stuck. So again, this is not an easy answer in a one minute answer to this question. There are more aspects involved into it.
Yeah.
Come on.
Okay. We can think.
Come in.
Sorry, anybody's talking now?
Yeah, please let her talk.
Yeah. We have other questions from audience called Shuai. She has several questions. First one is, hi, Andre, indeed, some stocks are undervalued. However, the regulation control in those markets may not be as advanced as investors face bigger risk. How would you evaluate the potential higher return and the related high risk people are facing?
Hey, Andre, when I ask these questions, you are explaining the potentials in the emerging market. So this question is particular for those kind of growing market and the risk we are facing there.
I'm sorry, because I didn't, I hear somebody's talking, but I don't know what they're talking. I can't hear what the question is, sorry. Try it again.
Try herself. I think she would like to ask the question by herself.
Yes.
So Shai, would you like to try again? I will put myself on mute.
Yes, can you hear me now?
I can hear you, but it's difficult to understand, but please try.
Yes, so what I'm trying to say here is my question was typed when you explained that we should pay a little bit more attention on the emerging market.
Yes.
But the problem in those markets is if you're talking about the shares listed in domestic exchange, the local regulation and the control and the monitoring may be the weak point to list the risk.
Sure.
If you're talking about those stock like Chinese stock listed in exchange in US, then US also have some regulation to restrict certain things or require more information disclosure. Those are all risk in those kind of companies. So how do you evaluate it and how do you find the right balance for the potential good return and maybe also bigger risk? So that's my question.
I understood your question. Thank you for the question. Again, so basically what you say is if I invest in emerging markets, there is different control, different regulation in these markets than in the developed world, okay? Now, the point is this, there are experts in this field. And again, I'm not the expert in this field. All I know is that there are instruments that you can use and you can judge yourself whether you like to take the risk on regulations, on being sure that you get what you want, that you get what you wanted. My other point is that this is exactly the problem that I thought it would go like now. Okay, if I touch emerging markets, you say, oh, emerging markets. If I took real estate, oh, maybe real estate. My whole point is this. I'm all fine. You can diversify the portfolio. You can think, oh, should I put my money in real estate? Should I put my money in emerging markets? You can do that. There are instruments. You can take a look at the risks. There is no easy way out. There's always a risk involved, okay? But there are good instruments to be bought and they are available and you can take a look at them. However, my other point is, this is what I'm trying to explain to you is, to me, there is a better strategy to use than thinking about diversification, thinking about where is the opportunity. because you now believe that investment is about looking for great companies, looking for great countries, putting them together, have your portfolio, and then you're done. This is not. This is logical. I addressed it. I talked about it. But my point is, this won't work in the future. You need something extra next to that. So instead of putting all your efforts, all your focus on looking for the next big thing, whether it be Tencent, Baidu, or God knows what kind of company, this to me is not the way investment should be. So it's very hard for me, because I have to first tell you what investment is, and then I tell you I would not do it like that. And now you say, but how do I do it? So yes, but you can do it like that, but I think there's a better way going forward. Yeah, it's a matter of language and communication as well. Okay, to me it's very hard to express myself in English and to make this point clear. But if you want to invest in emerging markets, I do it. I just buy an MSCI ETF. Yes, I have a risk in emerging markets. If I buy China, there is a China ETF. I buy the China ETF. There's loads of them. Okay, and yes, all of them have a certain risk, and you cannot hedge it. The risk is there. But overall, in your portfolio, there is a risk, and this risk you need to hedge. And this is where my focus comes from. Okay, so I want to I hope I can express myself and I explain this one, because what I'm going to tell you next is my part. The rest is all part number 1, part number 2 is all great, but I believe it's about part number 3. It's about what is your strategy to tackle all these risks. No, so nothing wrong with buying emerging markets, nothing wrong with having real estate, nothing wrong with having bonds, nothing wrong with. But in going forward, okay, I believe this strategy won't work.
Very good. Shuai, do you have more questions you would like to ask?
No, let's leave it now. I think, and we also want to go to the part 3. Let's leave it.
Yeah, we can also look at it in the end.
Yeah, maybe at another time afterwards, I can explain a bit more individually on the questions.
Yeah. Okay. André, would you like to move on, or we have several questions still? You would
like maybe there are some questions. Try a few of them.
Okay. One question from our guest Ting. She's asking, how do you think of the future of Bitcoin? Many people believe that nowadays Bitcoin has also defensive functions, just like gold.
Mm-hmm. Yeah. I invest a certain amount of my wealth in Bitcoin. Again, I'm not the expert there. Basically, as you can see, I'm not an expert in anything. Okay, not in Bitcoin, not in real estate, not in China, not in emerging markets. I'm not the expert there. But Bitcoin, what I do understand is, and actually I have it in my presentation, I guess. I do believe there is an opportunity there. And it's very simple. Would I put 100% of my wealth in Bitcoin? No. Would I put 0 in there? No. Would I put 3 to 5%? Yes. Why? Because I think I need to hedge it in a certain way. If Bitcoin is the way going forward, or Ether or cryptos or whatever it is, I can see that there is a need for something like this in the financial world, because it is a mess. And the mess that was created over time, it needs to be solved soon. And whether soon is the next 5 years or 10 years, I don't know. But it needs to be prepared. So I believe that Bitcoin is an opportunity for investors, and therefore I invest in cryptos and Bitcoin, but only 3 to 5%. But again, I'm not the expert. But the point is, if you understand that you're not the expert, and I do understand, the only thing that you have to focus on is about risk management. This is what I'm trying to tell you. Yes, is there an opportunity in Bitcoin? Yes. Emerging market? Yes. China? Yes. But the point is, I was wrong so many times in the past, because I thought, oh, this will happen in the future. This is a great company. This is logical. This will go on. And you hear these stories from professors and all people who have a lot of knowledge, and they tell you this will happen, this will happen. And if you look back in 5 years go back 5 years from now, and then go back on what they told you 5 years ago, go back on what they told you then, and look forward. And you have to, one story to address it. I was traveling 1990, that is a long time ago. In 1990, I was traveling, and on one of these airports, I saw a book, and the book was called The Great Depression of the 1990s. Ravi Batra, that was a professor, and he was writing a book about the Great Depression of the 1990s. I was reading this book. I said, whoa, this guy has a lot of knowledge. Whoa, what an insight, what a facts, what a great story. You know what happened? The Great Depression of the 1990s. It was the best 10 years in the stock market. So if a professor with so much knowledge writes a story like this, and then the complete opposite happened, what does that tell you? Stop listening to all these bullshit stories. So if I tell you buy emerging markets, if I tell you buy China, if I tell you buy Bitcoin, stop thinking about the bullshit stories. Because nobody knows. Yeah, but you said, yeah, but I have to make a decision. What should I buy? I said, okay, take something. It doesn't matter. What matters is, how do you manage your risk if you're wrong? This is the only important question. So yes, we can talk about, should I buy this company, this and this and this, and you have all the great stories. My point is this, bottom line, it all comes down to, what will you do when you are wrong? This is the big question to be addressed, and forget all the rest. Now, what I see here is, because the level of questions that you ask me, this is a high level of questions, okay, which tells me that you are a very intelligent audience. This is a very intelligent audience. The problem with a very intelligent audience is that they will keep on questioning like very detailed questions about whatever. But in the end, this is a simple game to play. In the end, you need to think simple. And a lot of people who have a lot of knowledge, all the people who are graduated and blah, 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 they are going more on the analysis side. They keep on analyzing, they keep on looking for great stories, okay? On the other side, you have these people who say, don't talk about it, just buy. It's too simple. So it's about action and analysis, and it has to come somewhere in the middle. And what I can see is, people who in the end are successful in financial markets are the people who have the right combination of both of them. Plus, one important thing, risk management. If you understand the concept of risk and the way that the traditional way of managing the risk, and understand where we are right now, the traditional way of managing your risk won't work. And I can explain to you, probably not in an hour time or half an hour time. I can give you examples, and I give you I can present a possibility to address this topic as well, to manage it. Okay, so this is my firm belief, and this is what is very difficult to bring forward for me. So I hope I do my best. This is what I can say.
André. Yeah. We understand that's why the following question, I think you will answer probably in sector 3. So the question is regarding the risk management, how to buy insurance for certain selected stocks, assuming this is not a stop loss setup.
No.
And yeah.
Correct.
Together with another person has a similar question is, I would like to be quite interested to learn the protection instrument André is about to introduce.
Yes. Okay.
So these are 2 related questions that
I think so, yes.
Will
talk
about in part 3.
Okay. But again, I appreciate your questions, and I find it a bit frustrating from my side. I find it a bit frustrating from my side that I want to, there's so much to be told, there's so much to be learned, and I can only do it in a short amount of time. And this is the challenge, next to the challenge of the language, which again, I'm not used to talking English.
We will figure the language problem here. I think the other question is also related from Wei Ming. It's same. And what do you mean there's the protection when you buy stocks? What do you mean there is a floor for stock, buy an insurance to cover the loss in investor stocks? So they're all related. So we put them together and together later.
I think so.
Yeah.
I think it's good to go on now, to move on now.
Yeah, let's go on.
Okay. All right. So my point is, so investing is for the long run, right? Okay. Take a look. This is the chart. This is why everybody tells you be involved in the stock market. And yes, they are right, because this is the statistics. These are the facts. But take a look at the next chart. This is a chart of the performance of Robeco. Robeco was the first in Europe, very big asset fund manager in Rotterdam, still existing. And they had a stock, and they are running this stock for many, many years. Now take a look what happened with the stock portfolio. In this portfolio, there were the 149 blue chips, so the best of the best of the best, selected by Robeco, with all these analysts, with all these clever guys and girls. And they set up this portfolio. And then suddenly they have a great story, why to invest in this portfolio, worldwide diversification. And you know what happened? Take a look what happened. 2000, 2003, boom, minus 62%. 2007, 2009, minus 58. Yeah, but they say, listen, investing is about the long term. So for the last 20 years, we make 6.9. My problem is, I met a guy who sold his business in 1999. He went to Robeco and he received this nice portfolio. And then in 3 years' time, he lost 62%. And he said, listen, I'm 60 years. If I now lose 62%, my wife wants me to stop because we cannot afford it anymore. If the market goes down more, I'm going bankrupt, or I need to take a job. And this was meant to be my pension. Okay, so I don't have any recovery time. And this guy had to wait for more than 15 years, 15 years, before he came back to square one. So that tells me that yes, the story is right. Investing is for the long term. But if you're unlucky and your timing is wrong, and you have a wave like this against you, mentally and financially, people cannot afford a wave like this. I'm not talking about somebody who's 25. Or maybe 35 years old. But if you're 55 years old or 65 years old, this is your risk. So this story is right. But this is also true as well. Okay. So you need to diversify, right? I talked about diversification. Everybody will tell you diversification is important. So blah, blah, blah. Okay, good. Now take a look at this chart. Take a look what happened anywhere between 2000 and 2003. So you have a great diversification. But take a look at real estate. Take a look at international value. Take a look at small caps, large caps, whatever diversification you had, everything went down the drain. It goes down altogether and it goes up altogether. And then take a look at the global financial crisis in 2007. Take a look. Real estate went down 70%. 70%. So great, this diversification, but it won't work. That is the lesson I learned, and a lot of people learned it the hard way. And this is why I tell you, think about what the traditional academic way is of managing your money. Now, this to me makes sense. This guy tells me, never lose money. Rule number 2, never forget rule number 1. Okay. Yeah, we start to laugh. Of course, it's funny, but he's right. If I lose 30%, I need to make 43 to break even again. If I lose 50 or 60, it's almost mission impossible to come back if time is running out. And unfortunately, time is running out for us, for all of us. And if you are at age like I am, time is running out definitely. Okay. Now, another thing, which is an important chart. Excuse me, this was in Dutch, but if you would make 8% a year, it's very stable, year after year, for 30 years, you make 8%, 8%, 8%, 8%, 8%. But what would happen if once every 10 years, you would have a drop of 30%? Take a look, what happens in the end? You start with 100,000, you end up with 220 after 30 years. Now, if you would make on a very stable way, you would make 8%, 8%, and you would avoid the 30% drop. 100,000 would be turned into 1 million. Okay, so that's a completely different story. So the question is, what is your strategy by trying to avoid a minus 30, 40, 50, 60%? Now, my answer is very simple: protect yourself. Now, the question is, how is that going to work? Now, this is a picture, and we can all hopefully understand it. How can you insure yourself against fire from your house? If you have a house, you buy fire insurance. And you judge yourself, this is your house, the value of your house, and you say, hey, I take a little bit of my own risk, but I want to protect this amount of money once my house goes down because of fire. Now, I can explain you a bit about making money on your house if you use, for instance, options. Okay, so options, derivatives, instruments on the financial markets is a very great way to use in your portfolio. So I can give you a simple example. Okay, so defensive strategy, starting very simple. You buy 100 shares, let's say Ahold. We all know that if you live in the Netherlands, you probably do your groceries sometimes by Albert Heijn, bol.com, the Dutch Amazon or the Dutch Alibaba is part of the Ahold concern. Okay, now if you buy 100 shares and let's say the investment is 24, the stock, you do an investment of 2,400. Now you buy an insurance against a drop in the price, and this is called a put option. To put it over there means you can transfer your stocks to somebody else. Okay, so we make a deal. You have the stocks, 100 stocks, and you want to protect yourself at a level of 22 for 1 year. Now, what will happen is you have the right to sell your shares at 22, but an insurance costs you money. You have to pay a premium. Let's say €1 per share. So your risk will be 24 minus strike price 22, which means your risk will be €2. This is your own risk. But the good news would be if you buy these shares, you get your dividend. Okay, so over time, if the company makes a profit, it pays the profit to the shareholders in a way of calling it dividend. Okay. Now, if the dividend in this stock is, for instance, a 4% dividend share, which means that you get €1. So the premium you pay for your insurance is the same as what you will lose on your dividend. So you will get your dividend, you will pay your dividend and buy a premium to protect yourself. Okay. So now the question is, what is your strategy now? You have for 24, you have the floor at 22, you pay €1, so the floor is basically at 21. You get €1 dividend, so basically it is 22. So now for the next year, you definitely know one thing for sure: whatever happens, you're protected. So you still have a risk of 2, but you will never have the risk of going down, because there's a floor. Okay. Of course, people will say, yeah, but that will cost me 4% a year because I won't get any dividend. Yeah, for sure. That's a choice. Okay. I am glad that I can make this choice. So I will definitely always protect myself and I will buy. Why? Because although I'm the expert, I know nothing. I don't know what will happen with Ahold. I expect the share to go up, but do I know for sure? Of course I don't know. Do I have a good story? I have a terrific story. Incredible story I have, but still I can be wrong. So if I have this protection, I know one thing for sure: I will keep my risk controlled. Now, these instruments you can buy. Okay, so if I start a lesson with a group of people, I would say, okay, put 80% of your money into a defensive strategy. Okay. And then what do I mean by defensive? Well, defensive means I want to control my wealth. What do I need? I need to actively manage my portfolio by selecting a certain put option, for instance. I will use strategies that will run for medium term. I will structure it with a hard protection. Okay. On the other hand, people like to trade. I like to trade. I like to buy and sell. Okay. It's a different game, completely different game. If you want to play this game right, you need the 3 M's. You need a method with an edge. You need money management, and you need, in this case, also a correct mindset. Now, we can all learn that. It's not difficult. It has a high potential. It's a nice game to play, but you need time, you need energy, you need a small amount of money, and you need to be aware of the fact that, again, that you have to be involved in something like this. To be successful, you need to be involved. If you don't have the time nor the interest to do this, forget about the offensive trades, forget about buying and selling cryptos, buying and selling stocks, buying and selling futures, etc. What is possible. It's a nice game. I like to play it, but I do it with 20% of my money. If this game is being, if I screw up with this game, 20% of my money is gone. Okay. But the most important thing for all of us is the 80%, the defensive strategy. This is what I call, this, messing around now. This is what I call the 3M, okay? You need a method. You need the right money management and you need the right mindset. I can teach you all of that. I've been involved in trading. I've been on the stock exchange, the floor as a trader, and I learned a lot by doing a lot of mistakes. Okay, making a lot of mistakes, but still I learned over time to have a decent method, a decent money management, and being very disciplined and strict with my money management. This is the only way that you can win this game. Nowadays, I see a lot of people being successful by trading, buying, selling cryptos, and everybody is successful. Forget it. In the end, 80–90% will lose the game because they don't have this structure. They don't have a method with an edge. They just have a stock, or they just have cryptos, and it goes up because the market is going up. They think they are successful, and they probably are. But what if the market is going down? A lot of them will lose the game in the end. Okay, there's no money management. They have too big positions. They don't have stop loss orders. They don't control the risk. All of them, they are greedy. They have the right mindset. No, they have the wrong mindset. Okay, so yeah, this is a completely different story. We can teach you about trading, but this is a different game. I would focus first of all on the 80%, on the defensive play. Now, again, being a millionaire, focus more on making money than saving it. Yeah, these are nice charts, and again, I put them into whatever. And it's nice to see it, but this is not what it is all about. You can have financial rules, and the internet is full with these pictures, and there's nothing wrong with this. It's all right, but it doesn't tell you what to do in the real world. Okay. Now I will tell you about my mindset. The two most important things that I learned over time is everything is possible. Okay. And rule number 2 is I don't know anything about the future. Now, the implication for my strategy is that, again, I need to take care of my risk. I read the book, The Black Swan, and I hope you will do too if you haven't done it yet. The Black Swan is a book by Nicholas Taleb, and it's a great book because it tells us about the fat tails, about the small chances in the world, but the high implications if something like a virus comes over, or something like a terrorist flying into a tower, or something like an accountant who screws up with the books of a company. The implications are incredible, and we never think about that. So I'm a strong believer of the Black Swan and the risk-reward idea. Now, of course, you will tell me, okay, yeah, but André, if you use these strategies with protecting your wealth and losing 4% on protection, how can we still make money? Well, I can only tell you, this is how we do it. This is the result. Am I successful every year? No. Take a look at 2016. We had a little minus, but it was not a big minus. It's not a minus like -30 or -40 or -50%. Never like that. Okay, so it's still possible to do this, and for this to explain how we do this and how these results are there in a portfolio. This is a portfolio of 50,000. We have a portfolio of 250. We have a portfolio of 10,000. So it's all a matter of what is the strategy, and there is a consistent strategy behind this. Okay, and this is what I would like to teach. Now, to have an idea, this is how I work. this is how we manage the risk. Now, Royal Dutch, a big oil company in the Netherlands, has been there for 100 years. And everybody will tell you, oh, buy it, you get a great dividend, and it will go on forever. Now, the stupid thing is, the stock was at 26 before COVID. It went down to 10. So from 26 to 10, this is an incredible drop, okay? Now, if you have just the stock because you thought it's a great company and you want to diversify, you want to have it in your portfolio, take a look on the blue line. This is the stock. If the stock is going down, the percentage will go up, minus percentage will go up, of course. So if you go from 16 to 10, you will have a drop like 30, 40%. Sure, you have your dividend, probably. But what would happen if I would do a construction? I use a floor. I use premium to sell, to collect money. I will give you an example soon. What if you do a strategy, really make a strategy out of it? Then I end up with a simulation and I say, listen, this is my way going forward. It's the red line. So I say, okay, if it's going up, you want to make as much money as possible? Sure, make 5%, 10, 15, 20, it's all fine. The blue line will go up. I cannot deliver the same results if the stock is going up. I'm fine with 6, 7, 8%. So my defensive portfolio, I'm fine with 6, 7, 8%. I'm not in there for 20, 30, 40, 50% in my defensive portfolio. I'm fine with 5, 6, 7, 8, 9, whatever it is. So here you can see that I choose to have a little bit less upside, but therefore I buy my protection. And what I end up with is a very small downside. So I don't like to lose, okay? But of course, there's a risk that I lose, but I want to control my risk. And this is the way I do a strategy. Now, this strategy consists of a few steps. My first step is that instead of buying 100 shares, I buy one call option. Now, I have to challenge now to explain to you what a call option is. Let's do the following exercise. You have a nice house, let's say 500,000 worth it. And I come by and I ring the bell and I say, listen, I would like to have the right to buy a house for 550. And I want to think about my proposal, whether I buy it or not for 1 year. Okay, you say, so hang on. You have a house of 500K. I come by and I say, listen, I want to have the right to buy it at 550, and I want to think about it for 1 year. Does that mean that I buy the house now? No, I want to think about it, buying it at 550 for 1 year. What will happen is I buy you a premium. Let's say I buy you 5K cash now to give me this right. What's the situation? You have your house and I have a right to buy a house at 550 and I paid 5,000 euros premium. Now what can happen in 1 year time? The house prices go up and suddenly it's at 600. What will happen? I will come back to you and say, listen, here's my right, my option to buy it, my call option. I call your house. I want your house. I pay 550. I will sell it at 600. I make 50K and I just paid 5 for it. So I make 45K profit. That's one. So I'm perfectly treated here in this case. I'm fine. What will happen to you? Well, you had your house at 500. It went up to 600, but you stopped yourself out at 550. So you will have 10% upside plus the 5,000 bonus I gave to you. So you have also a great story. But what happened now if the market stays at 500K and we are 1 year down the road? I have a right to buy your house at 550. Will I do that? No, because the price is still here. So I won't exercise my option. What will happen now is that you earned 5,000 euro cash on your property because mine is gone. I lost 5,000. Can I lose more than 5,000? The question is no. Why not? I have the right to buy it, not the obligation to buy it. So my 5K is gone. You have your house and you still have the upside. I lost my money in this case. Now, my risk is 5K and maybe I make 50 or I lose 5. So I have a huge upside, but I have a small downside, which is only the 5K. We have two situations now. If you have your house or you have a stock portfolio and you are fine with 10% profit a year, you could sell the upside and receive a premium. If you do that, this premium that you earn on your property, on your stock portfolio in this case, this premium you could use to buy a floor. So it won't cost you anything. You protect yourself to the downside. You limit yourself to the upside. This might sound a bit strange or complicated, but this is the way I work. What I do is I'm fine with 5, 6, 7, 8, 9% profit in 6 months. This is mostly on average. I use strategies for 3 to 6 months. And then I do another strategy for 3 to 6 months and another one for 3 to 6 months. If I can make 5, 6, 7% every quarter, and of course not every quarter is successful, but if I make 5, 6, 7% every quarter, that means that I can use this premium to protect myself in the downside. And then if you do a strategy like this, you end up with a simulation where I can maybe lose over time 5, 6, 7, 8%. Could be, but I still have upside, okay? But not as much as if I would have an unhedged portfolio or a stock, because yeah, the stock is going up or down, and of course you have more potential, but you also have more risk. And in a defensive portfolio, and I will tell you, you will need this defense for the next decade and maybe decades to use this defense to control your money, because we live in a very overvalued world, I would say. Okay, so the risk is probably higher than 10 years ago. Now, you can do all kinds of simulations, you can do all kinds of strategies. Now, my dilemma now is that if I want to teach you this strategy, if I want to go step by step, that's possible, but that takes time. Okay, let's face it, I cannot do it right now. So I can only tell you my thinking, my experience and the way I use this to come up with my track record and to have a defensive portfolio. Tell you what, my portfolio in 2020, when COVID arrived, the market went down 38%. I was down, the maximum I was down 3%. Okay, in the end, I was up 6, 7%. But I was only down 3% when the market tanked like 38%. This is what I mean, effective risk management, efficient risk management. And this is what I want to share. I want to share these insights. I want to share the strategy. I want to show you how that works to people who are interested in it, okay? And yeah, you can do all kinds of mathematics and I have to explain it to you, but that really, yeah, takes time, as you probably understand. Now, I promised you also a little bit. So this was about my strategy and my approach. I also want to give you a little bit of insight on how to do timing in financial markets. Because, yeah, what to buy is one problem. When to buy is another problem. For many, many years, I've been studying trends. I've been studying patterns. And nowadays, I make use of a computer, I make use of algorithms, I make use of knowledge that we digged up over time, and I made use of a team of software engineers that I worked together with, and we were able to come up with a strategy, not the strategy I was just telling you about, but a different strategy for trading, okay? So you have trading, do it in an automated way, and do it in a very disciplined way. And you have the defensive strategy, which is something different, okay? So on the trading side, I make use of a computer program of algorithms. And the big advantage of the computer is that it's very strict, very risk control, 24 hours a day. And the basic of this is looking for trends and patterns, okay? Now, I will share you an indicator. And this indicator I can teach you as well. And you could use this indicator. Now, I try to explain a little bit about this indicator. This is the last part of my presentation, by the way. So if you're getting a bit tired, I can understand. But I hope this is the last part. and I want to share this with you as a bonus. If I say a golden tip, it means a technical, interesting pattern. So TIP, because I don't believe in golden tips. Okay, it's about a golden structure. Now, I want to share this indicator with you. What is the indicator doing? The indicator is measuring momentum. Now, take a look. If I have to explain what momentum is, take a look at this. I throw it up in the air and I catch it. What is it that I'm trying to express here? If you would make noise, then you would see like here, it stops, but we don't see that. We only notice it once we see this. So you see the acceleration of the move. This, you can measure the same with prices going up. Now, the way you do that is by calculating the difference in the closing prices. Okay, so if today we are higher than yesterday, we have a plus. If tomorrow we are higher than yesterday in €1, and the next day we go up €2, then there is still an increase, €1, €2, etc. But suddenly we see an increase, maybe 20 cents, it still goes up, but the measurement, the amount of acceleration is going down. Now this indicator here, down here, tells you when is there a move that is going too fast in a short amount of time. So my indicator tells me, listen, we are now in a dangerous area. The market is overbought, is went up too fast, too high. So probably, most likely, you will see a deceleration. You will probably see a trend reversal. Now, I look for divergence. What I look for is that if I see prices go up, but I see my indicator going down and is in an extreme area. So I measure the extreme area. I look for prices to go up, but the indicator going down. So the momentum is going down. So we see it going up, okay, but the rate of acceleration is going down, which means the chances of going the opposite way is increasing. Now here you see a few turning points, and you always see more or less the same, not in every turning point, by the way, because here, for instance, there was no indication. Here there was no indication. So it's not every trend reversal, my indicator is perfect. There's nothing like a perfect indicator, okay? But it's good enough, it gives me an edge, and it tells me, listen, the risk is now more, or the opportunity is greater. Now, recently I bought China, okay? Why did I buy China? To be honest, my indicator told me. The indicator was like, it went down, here you see the drop, it stabilizes, and then it went down again. And it is, if you put a ball below the water surface, so try to put a ball in the swimming pool, put it under the water, and try to press it more down. And suddenly, if you cannot press it anymore, you leave it, it's going like up, it's coming up. So this pattern is like the ball in the swimming pool, okay? And it went up. And yeah, when did I buy? I bought it just a little bit before it really accelerated. So it was a nice turning point. Is this always perfect? No, nothing is always perfect. Can I protect my investments? Yes, I will always do. So I buy, and I still know that it is possible the opportunity comes. But even if I believe and think that it's going up, I still always ask myself the question, what if I am wrong? What if I'm wrong? I want to put my floor. So yes, I take part of the move, but I still have my protection. Will I fully profit from the move up? No, only a certain percentage. Okay, but that's fine with me because I want to have a strategic defensive strategy here. Bitcoin, same question, same strategy, same idea. We had this huge move in April. It was up, one move up, second move up, third move up. And look what my indicator tells me. The indicator goes down. So it goes up, but here it went down for a long stretch. And suddenly, I have certain rules involved here. Suddenly I say, okay, now is the time. And it has to do with a certain deceleration of this pattern. So it's not enough to only see the divergence, to see it going up and going down. It's also about the timing of when, okay? So you know that you're in an environment basically for selling, but the exact moment has something to do with another decision rule you have to make. Now here you see the ball in the swimming pool on the downside here. You see it going down, 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 but it decelerates, and you see the indicator going up, up, up. So it tells me we are in extreme. We went too fast, too much down. So we probably get a recovery. Okay. And you see small moves like this one here. And again, I cannot predict. I don't know if something like this comes and tells me, oh, we are 30,000 and now in 3 months' time we will be at 60. This is not what the indicator tells me. The indicator tells me there's a very high probability that the market will not go down anymore, that the pressure down is exhausted, and it's probably taking a U-turn. It's coming up. So if you want to participate, do it from the long side. Buy now and see what it brings you. Okay. So then a lot of other questions come in, like when should I take my profit? How much? How long will this last? How do I measure, etc., etc. So it's not simple as this. Now, I told you about interest rates, and I told you about a very important moment in maybe in history even where we are right now. Because if you take a look on interest rates, here you see the government bonds, which is the government bonds in Germany. And you see an important point coming in here. So again, this is Tesla, for instance. Okay, so you can take a look at all kinds of things. This is this innovation fund of Katie Wood I talked to you about. It was going up, 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 and suddenly the indicator signal. This was China. Now again, bitcoins. You can see even zoom in smaller details. But again, yeah, I don't know what happened here. So yeah, here you see ASML, which is a big company in the Netherlands, the biggest chip producing company in the Netherlands, chip machines, I should say. So TSMC in Taiwan is one of the big companies. Intel is one of the companies. ASML is worth 250 billion. It's a great company. However, sometimes markets are overly enthusiastic. So here I did a trade. So to show you what we did. Now for the last 10 years, I've been doing an update on Sunday. So now once I stop here, I go home and I make my update, my weekly update, and I will share with my audience. And one of them is I show them my trades. So this is one of the trades I communicated. Might be complicated, but to show you that we did something on the 17th of September, and 2 weeks later, on the 1st of October, we closed the trade. Okay, this was the money involved here was only 280 euros, and yeah, we made a 470 profit. But this is on a small portfolio, so this is trading. This is like 2 weeks time frame. So this is what we share. So I share the insights, I share the trades, I share the strategy. It all depends on what people like to look at. But I use this indicator and I tell people, hey, listen, we are now in this swimming pool pattern. So be aware, we could see a trade here. ING, the bank, you can do the same. Okay, we did another trade like, and I do these trades with risk management. Okay, this is like 500 euros involved. And this took on for 8th of August for the 1st of, so this, no, September. So this was for 3-4 weeks. So you can do a lot. This is about trading. So you have the 80-20, the defensive strategies, and the 80% is the active trading strategies. Now, to have an idea, yes, what could we do? Because people ask my track record, can you present it? Everything is logged, okay? We are completely transparent. Everything we said, we did, is on our website. People can go back years from now and see what we did. So this is all about a small portfolio, a trading portfolio. And of course, it's for a broad audience in this case, okay? So this is what I would like to share with you. Then next to that, I want to end my presentation by telling you a little bit about another initiative we took a year ago. And we started a fund where people could invest, and especially on the trading side, they could share our strategies. And we made an investment fund. It's called the Brouwers Fund, my personal name, Brouwers Capital. Basically, the idea behind this is that this is a strategy with, again, on focus on risk management and making money in every kind of market. Whether the markets for the next 5 years will go up or down or whatever they will do, we try to make money. Okay, so even if the markets go down, we try to come up with a positive return. Is there a guarantee? There will never be a guarantee. We cannot guarantee that. Did we do a good job? For the last 15 years, we did a good job. Although we are running recently this strategy for other people's money as well, so people can share and can participate with us. We've been trading live since 2018, 18, 19, 20. For 3 years we run live, then we shared the possibility to share with other people to invest in our company. And next to that, we've been doing a simulation for the last 15 years. So we can tell you more if people are interested in participating with our fund. The only level of participation is a minimum of 100K, 100,000 euro is the minimum. This has to do with regulation, etc. in the Netherlands. So I want to end this presentation, and I hope you got some insights. Probably you have more questions now than before, which is hopefully the case. I couldn't address everything. Sorry for that. I did my best to share as much insight as I have. Again, I don't know anything with regard to the future. All I know is that this game is about playing great defense, not about playing great offense. That's what I learned. And if people like to be involved in financial markets, like to think about how to make a return for the next years going forward, we are definitely willing to help. We do coaching, and an idea came up I want to share with you. An idea might be, each year in January, I start with a new group. Dutch people most of the time, but if there is enough interest, we could start a group. So we could do a coaching group for 1 year, and I will teach you my strategy. I will show you the trades. I will show you the strategy, and you can learn more on this. So if that might be of interest for you, let Wen and Gabi know. Let these people do their thing. Let them contact you, or you contact them, and you can think about the opportunities. Again, I'm thankful. I hope you are okay with this so far. And if there are any more questions, I'm willing to take them. But I think for now, this is what I had to say. Thank you.
Wow. Thank you, Andre. You know, like I have to say, is it your first time giving the presentation for the major Chinese community?
Yeah, and also the first time I had to do this in English, which is, to be honest, I did one more long time ago. And the problem is, Dutch is okay. German is fine with me, but English is still struggling a bit, because I'm still looking, I'm thinking so fast in Dutch, because I did this for 20 years, and now I have to translate all these things into English, which is a bit complicated, but hopefully it was not too bad for you.
No, we couldn't tell it at all. It's so
Chinese will be another challenge, but I think I won't make it in my life.
Yeah, so, and like first of all, like you know, just want to let everybody else know, and for this time, like and Andre and you know, also Tom, together with us, we spend quite many hours to preparing this content, because we know all the participants really come from different stages, and some of them already have more than 10 years of trading stock market experiences. Some of them come from the financial investment sectors. Some of them are business owners, professional managers, or people like me. We just actually like enthusiastic on learning the stock and trading. So, and I hope like from this morning and the presentation and sharing from Andre has covered most of the aspect. And so, of course, we do still have the one section, like we reserve the time, because we want to really, like most of our audience, your questions are being answered. Yeah, I know like in between one already raised a few questions, and now I'm also quickly going through the chat messages. In the meantime, if you have some questions, also leave on the chat box. So for instance, I found out one message which is given by Si Jiachen. He is asking like with which tool we can buy and put the put call option for our stocks.
Nowadays, if you open an account with a broker, and I would suggest go to a broker, a specialized broker, instead of a big bank, because the platforms that the big banks are using platforms that are not as modernized as the ones from the specialized brokers. So I personally have an account with a few brokers. One of them is Links, which is Interactive Brokers in the Netherlands. One of them is Saxo, which has been the former Big Bank or Alex. These are two very professional platforms that everybody can use. So you open an account, put your money in the account, and you are off. Okay, and you can find your stocks, and you will find your derivatives, you will find your ETFs for emerging markets, you will find your put and call options if you want to. It's all available. It's all there. You can use your charts, etc. So these are very professional platforms that everybody can make use of.
That is actually very practical information. Those are the most used by the platforms. Okay, I hope this answered the question by Jatin. Yeah. So, and another hand, the question is given by Cody. Cody, she's asking is how active do you need to be for the 80%? Yeah, that's a very good question. For the 80%, basically, if you learn the structure, if you know what to do, it takes care of itself. So if the markets are quiet, you need to maybe interfere one every 3 to 6 months. Okay. You need to be, of course, you have to, in a certain way, you have to follow what you have. But it's not necessary, definitely not necessary to follow it each year. It's make the right structure, and then it takes care of itself. Again, I trade it every 3 to 6 months on a defensive portfolio. I will change the things. But you could even do that for 12 months if you like to do it like that. So it depends on whatever you're looking for. But the 80% portfolio is about the structure. Okay, the 20% is you can make a lot of money by doing 10 trades a day if you want to, but that of course involves a lot of time. But that's not necessary. And even in trading, it's possible, like I did, making a trade every 3-4 weeks. It's even possible to do something like that as well. Wow, great, thank you. Yeah, so and in the meantime, before we jump into the more questions, and so our Connect Now team, could you send the event survey to everyone via the Zoom chat? And I already got some feedbacks from some audience, and thanks for the André, your presentation and your time, the time you spent. So and then I got the question from the, I think Anqi, and she asked, can you type the platform names on the chat box, or maybe Tom can help with that.
Can I type there? Sorry.
The name of those platforms you were.
Oh, I will share with you. You can send it to them. Awesome.
That's great. Yes. Okay. And another question, actually, I got it. It's also prepared before our event. Yeah. So the question is, the Dutch government announced 1.3 billion euro investing on sustainable energy in Prijzendag this year. I guess this is Dutch. Mm. Is there a chance to utilize this policy and gain some margin by investing on sustainable energy? So we'd like to hear you.
I think, Gabi, to be honest, I think we should leave this question for now. And maybe it's possible that I address a few questions like this a bit more detailed later on. Okay. So I'm more than willing to take these questions on, but maybe afterwards and give a response to these people who asked the questions.
Okay, sounds good. Yes.
Yeah. Okay.
So do we have more questions?
You're checking the inbox, I guess, now?
Yeah, I'm checking the inbox.
That's okay. It's okay.
Okay, one more said maybe a podcast in the future. Oh, podcast, I guess he wants to say.
A forecast?
The podcast. Maybe we should do the podcast with you in the future.
Oh, podcast. Actually, I did a podcast. We have a podcast in Dutch. So again, we are mainly focused on the Dutch audience, of course. So in English, we don't have a podcast yet. might be an interesting idea. We are looking to expand a bit more international, to be honest, since you reached out to us and said, okay, what could we do for the Chinese audience? And I think, okay, that's an interesting idea. Let's go forward. So this is the reason why I said, okay, we're open. Maybe this is an opportunity. Definitely, if we set up a program, international program in English for education, for coaching, this would probably be the time to do it. So I have an invitation from an audience in Dubai next month. So as you know, I will be there for 4 or 5 weeks. And yes, there is also interest from this side. But the ideal way to go forward for your audience would be take a look whether there's interest or not, setting up an English group, English speaking group for coaching for maybe next year. That's another possibility.
Wow, that's great. Yes, yes. So in the meantime, we also got the question from Filippo. Yes. And what he wrote here is, thanks, Andrew. It was a tremendous presentation. And my understanding is this is indeed a milestone for you and also for the Chinese investors based in Holland. That's great. The message was very clear. My final question, how can we invest into your quant funds?
Quant fund, the Brouwers fund.
Okay, the trading fund.
As I am interested in.
Okay, investing in the trading fund is open for everyone except when you are a US citizen. Then we are not allowed to take you on board. But basically, everyone who has a minimum participation level of 100,000, and I personally want to meet the person who wants to participate in our fund. Okay, so if people are interested, please take the interest, and I will come back to them and I will tell them what's possible and what's not possible. But basically, the level of investment should at least be 100K. That's an important one, and you should be whether you are Chinese or Dutch or whatever your passport is, that's no problem, as long as you're not USA, because then we cannot take you on board.
Got it. So, and it looks like there are a few conditions. One is you really want to meet the potential investors.
Yeah, I find it important that people understand what we do with their money. Okay, this is why I'm into education. I want to meet every participant. It takes a lot of energy, a lot of time, but this is the way I want to build a relationship with the investor. The investor took a lot of energy and time to raise this money, to earn this money, and now if I have to take care of it, that's fine. That's my job, but I want to have a fully understanding on both sides of what to expect. Okay, and I find it very important to see. And I'm also responsible, in a way, I'm responsible to take on board the right people. It might sound silly, but this is also legal restrictions, etc., etc. So I have to inform in the correct way. We made a prospectus. I have to hand over the prospectus. People have to be fully aware of the risk, and I want to make sure that everybody understands what we're going to do. Okay.
Since I received some private message about the fund information, if anybody interested in the fund, please contact with us, because we can send information later after this presentation, because not everybody interested in that. But if you do, please contact with us.
Yes.
Yes. We also got the lady, she's already asking about your coaching program, the one we're going to launch the next year.
Mm-hmm. Yeah, I get this is an idea. Okay, nothing is written in stone here. All I'm saying is that again, I get this response from Dubai, I get a response from you, from China environment. It might be an idea. Okay, I will start a class. It's all about the defensive and the offensive strategies. Okay, I will come up with a strategy. I will hand them over to the participants in the coaching group, but I want them to fully understand what's going on. So I want to teach the strategy. In 1 year time, you will learn the strategy, and I will give you examples of what to do with your money. So there is a portfolio involved. I will trade my own, and I will share all my ideas and all my strategies. Okay, and but before we can do that, we have to make sure that people understand what the strategy is all about. Okay, so it's education plus the information plus the portfolio in 1 year. this is how the program looks like. And yeah, since we're doing this now in a Dutch language, I think for your audience, it's probably necessary to do an English language group. So this is what could be an idea, but it all depends on whether there's interest for this, yes or no. And if there's enough interest, we could think about it, start talking about it, etc., etc.
Sounds good. Sounds good. Yes. Now, let's see. I think, we already got some good feedback from our participant and audience, and now it's also about to nearby 12 o'clock. And so please, we just send the link, the survey link, to connect your feedback for this event. Yeah, because like what Andrew mentioned, our goal is really to build up the understanding and the trust between each other. And because investment is our lifelong game, and we need to play.
Correct.
Yes. So
I totally agree.
Yeah. So this is our official, the first, really it's our a virgin show, official event we have done together. And this is also the end of the year. We're already planning up for the upcoming year. We will have a lot of events, and together with our partner and Brouwers Capital together. So we want to really deliver the high standard and the systematic investment, education, information, and solutions for our Chinese community in Netherlands. Really, thank you. First of all, really thank you, Andrew and Tom, for all the hours and time you put it in. And also thank you for our team, Liu Wen, Zikun, and Dulei to be here. And also really great to see some old friends are here. And also glad to meet some new friends. Please follow up, stay in our WeChat group, and Andrew also join us by WeChat group.
Yeah.
Yeah. So let's really make our community grow, and by learning communication. Yeah.
Okay.
Thank you.
Very good. Thank you all.
Thank you all.
Bye-bye.
Have a nice Sunday, Stu.
Okay. Yeah, thank you. Bye-bye.
Goodbye.
Okay,
Thank you.
Feel free to ask all questions after presentation, please. In the
Thank you
WeChat
very
group,
much.
anywhere, we will come back to you. Thanks. Bye-bye.
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 Right.
Gabby 留一下，我们总结一下。
我们待会儿这样吧，重新再进一次会可以啊。
哦，好。
因为对，可能因为有些挂机的朋友们，
我们等大家都退了吧。
对，你的一般都会看到，可能就说，如果到最后的话，还有朋友还没有退的话，就是挂的机才，我们就能知道他这个整个上课的一个参与度。
意犹未尽。我希望安德能看到这些留言。志坤啊，这个留言有没有办法把它剪切下来，或者说，有人在问怎么进微信群？
啊，行，我给他留一下我们那个客服号，然后邀请他进。
对。
对。然后志坤，就麻烦你做几个事儿哈，一个是像刘文姐刚刚说的，你把他们的留言的反馈，你把它剪切下来哈。剪切下来的话呢，我马上发到我们自己的微信群里面来。好，这个是我们要做的一个会后的一个准备，而且包括我们的网站上也要用这个的哈。你先剪切一下这个哈，还有今天会议的这个图片，你记一下啊。
Gabby， 我把就是会议的那个纪要什么的，然后我放到那个叫什么那个 Google Drive 上面了，但是。我待会儿得明天得再做一个整理，因为他那个讲的好多案例什么的，我待会儿得揉到那个。
对，这个待会儿再讲，我们重新进一次，再讲工作上的事情，因为现在还有那个 guest 在上面。
好。
对。
我们先欢送大家。
欢送。
面带微笑，先欢送大家。
哦，我这边存了我们的这个 chat 里面的聊天了。
好，谢谢。
我在群里面发一下。
因为我们这样的话，群里说有些问题，如果我们还没有 cover 到的话，我们可以事后再看一下，有些问题怎么可以回答，就是他那个留言群里面。
对，因为我们这边还有一个问题啊，大家说的是需要这个 platform。But I'm still in the meeting.
Congratulations.
Thank you. See ya.
我们现在可以停止录制了吧？
这会儿可以停止录制了。
可以。
嗯。
辛苦。